and raise any questions or comments on the chat. If there's something pressing, raise your hand, come in. But yeah, in general, let's also all keep mute so that we keep the quality of the call, and we can all benefit from this exercise. I don't want to take much time. I don't have much to say at this stage. I will be coming right at the end to give the closing remarks. Welcome. Homotso, Henry, we are in your hands, sir.
Morning, everybody. John, thank you for the introduction. Appreciate it. I can see we have some of the names that I can recognize from yesterday. So as John said, thank you everyone for coming back. We are doing the, I would say, infamous QuickScan C today. So, you know, it's obviously the section that is very technical, very much numbers orientated. But our objective today is to take this call it complicated, intriguing model and simplify it into basic terms. Because fundamentally, even though it is finance, the ideas and the concepts can be broken down into their smallest components so that, you know, even us as everyday people understand what it is we're doing and what it is we're trying to populate as we navigate this QuickScan C. In terms of what we'll be covering today, we'll spend the first bit of this morning talking through some basic financial terminology. And maybe I can take a moment there just to ask in the room, do we have any professionals, i.e. do we have any QSs? Do we have any architects? Do we have any civil, structural, electrical engineers? If we do, maybe you can just post on the chat, just so we can have a sense of who's in the room today. And also if we have any people who are in the finance sector, so accountants, people who work at a bank. I'll take a few seconds just to see if there is, okay. Puti, how are you? Puti, the QS.
I'm well, thanks, and yourself?
Good, good, welcome. Okay, we've got another, Miche Ndorozo. Okay, so we've got a few experienced professionals in the room. What I am going to ask is that in order to understand the QuickScan C, we need to take it a little bit slowly, and so that everyone in the room gets to a point where we all have a solid grounding. So please bear with us if you know it's a bit slow and we're basically explaining some basic things, but it's very important that we get the foundations right so that when we get to the latter part of the presentation, which is actually getting into the model, everybody has a basic understanding. So as I mentioned, the first section will be basic financial terminology. Then we'll take a few minutes to take some questions and have a general discussion. And then we'll move on to key performance indicators. So these are very important because the crux of this model is what I would call risk analysis. And the Schroer have built 5 key performance indicators which really drive their risk analysis in assessing the QuickScan C. We'll touch very briefly on feasibility costing basics. And I'll say up front, at that section, I am going to pick on the QSs a little bit, so you're forewarned. And then after that, we'll also take a few questions. And in the last section, we'll get into the meat of the presentation, which is how do we navigate the QuickScan C. Alec, engineer, Mandla, civil engineer, project manager, Claudette, Kobani, project manager. Okay, that's great. So we have quite a broad spectrum of people in the room today. And I'm going to ask that throughout the presentation, you know, let's make it engaging. So if I ask you in the room and I ask for your feedback, please don't feel like I'm picking on you. The most important thing is there's no right or wrong answer. If anything, like I said, we want this to make it a conversation so that we can all share our knowledge as we move forward. So let's get started with the basic financial terminology. So if we're thinking about financial terminology, I actually want to take a step back because essentially all of this relates to two documents, an income statement and a balance sheet. A balance sheet defines how capital comes into a business, whether it be through equity or debt, and it also defines how capital is employed in the business. So, i.e., how do you invest that capital? I.e., how do you create the assets that the business owns? Then moving from the balance sheet, you go to the income statement. And the income statement talks to, once you've employed that capital and you've created or acquired those assets, how do you generate income from those assets? And in that generation of income, how is money spent? So fundamentally, everything we're going to be talking about today talks to those two statements. The income statement, how money comes into the business and how money is spent, and the balance sheet, how capital comes into the business and how that capital is employed. So I'm going to throw it out to the room. Perhaps I'll, and not to pick on anyone, but I'll say to Claudette, to Mandla, it's on the screen, but can you give us a suggestion on, if we're talking about income in a very simplistic term, what is that? What is the income?
It's money coming into the business.
Agreed. And obviously, in order to, that money is basically coming in based on some sort of product or asset that you have in your business that is used to create that source of income. In our business, which is the business of rental housing, the main generator of income is the use and occupation of the space. So, i.e., renting out your space to your tenants. However, you can also have commercial sources of income. So, Claudette, not to pick on you again, but what would you think we could define that as? Aside from the commercial space that I've shown in the slides, can you think of any other sources of income that would be defined as commercial within the context of residential letting? And if anyone in the room wants to also volunteer and answer, please feel free. So obviously the first and obvious one would be, like many of us have seen in the CBD, where you've got a mixed-use building, residential on the top stories, and commercial shops on the ground floor. So we call that commercial income. However, commercial sources can also be if you've got an early development center, or otherwise called a creche. If you've maybe got a gym, an internet shop, and in some instances, parking, depending on which market you're in. So to summarize this slide, income, money coming into the business, it can have different sources, either residential rental income, which is the base for this type of business, i.e. social housing, and you can also have other commercial sources of income. So we're still talking about money coming in. Then there's, I mentioned earlier, there's the other source of income called parking. Parking is not always a source of income. Traditionally, in a high density residential building, it wouldn't be a source of income, but you do find that in areas where there's limited amount of parking, you can actually charge for use of parkings. And I'm sure most of us have had the experience where you have a 2-bed, 1-bath, you get 2 free bays, but should you want any more bays, you have to pay for that, and hence it can become a source of income. Then there's also the recovery of operating costs. So we'll get into what operating costs are in the next slide, but the recovery of operating costs is those costs which are traditionally tied to the consumption by the occupant of the space, so i.e. your tenant, and therefore as the landlord, you're recovering them from that tenant because it's what they used, and typically we'd call that their utility consumption. Then there's vacancy. So Vacancy is important because it's essentially the opportunity cost of income not earned through a space not being let. It can fluctuate, and typically it does, especially in a new building. However, when we model for the QuickScan C and general financial modeling, we typically look at the long-term vacancy. So looking at historical trends in similar buildings or in buildings within a portfolio that the applicant is managing, you would estimate to say over a 5-year period or over a 10-year period, this is the estimated vacancy that we've seen in our portfolio. And that ranges, some operators will say that it goes all the way down to 3%. Some buildings are sitting at 10%, but traditionally, once a building is sitting at above 10% vacancies, there are some concerns. And a good reference to sort of benchmark this is a report that is published by the report called the Rueda Report, which publishes sort of rentals, cap rates, and also vacancies for the cross-section of assets from commercial, industrial, and they also do residential. Escalation. Can anyone in the room volunteer to explain what is escalation? Why is it important? Zain, I'm going to ask you for your contribution. I think we had some discussions yesterday.
Escalation refers to the general increase in prices, obviously due to inflation and stuff like that. So leases and obviously also operating costs need to take that into consideration on an annual basis. So incomes and expenses are adjusted accordingly.
Agreed. And it's I would almost say it's a bit of a chicken and egg situation, because the main reason why we escalate anything is so that we maintain the purchasing power of our money. So i.e., we want to make sure that the income we are earning is at least comparative, if not more, to the change in inflation in the economy. And to explain it differently, the income we are earning has to basically service the expenses that we have to incur as our operating costs. We have all experienced the increasing inflation in rates and taxes. We've experienced the increasing inflation in electricity charges and water charges. And I'm sure we've noticed that typically those municipal costs escalate at more than inflation. Historically for the last few years, inflation has been between 3.5% and 4.5%, obviously based on the Reserve Bank inflation targeting mandate to keep it between 3% and 6%. But we have seen that the municipalities consistently pass through the costs through escalations, and those have been anywhere between 6 to 8%. In some municipalities, even higher for electricity. So then it becomes a problem that if the income we are earning is fairly staying static, but all our operating costs are increasing, obviously what it means is the purchasing power of our money is decreasing. Hence why we need to escalate our rental incomes. But that needs to be balanced against affordability, because at the end of the day, our clients are our tenants, and they're making their decisions on occupation, one on necessity, but also on affordability. So it then becomes a business decision as the operator to say, are you going to consistently escalate your rentals by inflation? Are you going to escalate them at 6% or at 7%? And in some years, perhaps you might not escalate your rentals. And so it becomes very much a business decision where you have to balance the understanding the affordability of your clients and also maintaining the purchasing power of your money, because you have to maintain your operating costs. You'll see as we get into the QuickScan C that the model assumes a static escalation of 4%, which is really informed by the historical inflation, CPI inflation over the medium term. Any questions on that? I think we've covered a lot about understanding if you're looking at an income statement, how does the money come in and what affects the money? So what we call money coming in through rentals, through commercial income, and then you need to make sure that you're also recovering some of your operating costs. So that's also money coming in. And if you have parking as an income, that could also be money coming in. And then the vacancy is an adjustment for money that's supposed to be coming in, but you don't get it because those units are not occupied. And then also escalation, lastly, is the annual change or increase that you're implementing on your sources of income. Any questions on that? So then we come to this very, very important, and I would argue this is one of the most important line items, if you can call it a matrix, in the property industry. It doesn't matter whether you're in residential, in commercial, in retail. This concept of operating income is how income is benchmarked in the property sector. In essence, it's a measure of the earning power on ongoing operations. So to the extent that the business is a going concern, the operating income is the amount of profit realized from the ongoing operation. And essentially all it is you say gross rental being your main sources of income through residential and commercial, adjusted for the vacancy, as we talked about the opportunity cost, then deducting the direct operating costs, which we'll come into now, and also deducting the overhead costs, we'll also go into that. That gives you operating income. So in other circles in finance, they would call this earnings before income and tax, EBITDA, but really all it is gross rentals, less vacancies, minus your operating costs, a measure of the profitability of ongoing operations. However, it's important to note that this is before any financing related items. So we haven't really taken into account how we service the capital that we used in order to be able to create this income. So let's keep this metric in mind because it's very, very important. I know that, you know, in different sessions, I think Henry touched on it briefly yesterday, when you talk about a property's return, a cap rate, all of that is measured off this metric, operating income. And in some instances, people will refer to it as net income, but all they're talking about is operating income. Gross income, less vacancies, less your expenses, gives you this metric of operating income. I mentioned earlier that the operating costs are essentially the costs associated with what we spend on the building. And maybe I'm going to ask also in the group here that let's throw around what we understand intuitively of what are the costs when we operate a building. Cameron, I don't want to pick on you, but do you have any thoughts?
Yeah, so I think your rates and taxes and expenses like that will be included in your operating costs.
Agreed. What would you think is the difference between the direct operating costs and the overheads, or you can call it indirect?
Yeah, so I think your direct operating expenses will be expenses that directly affect the property. So like I said, rates and taxes, your maintenance, that sort of stuff. And then your indirect operating expenses will be stuff that don't really have a direct effect on the property.
Agreed.
So like I said, for instance, your accountant's fees, your marketing of the property, legal fees to draw up leases, that sort of stuff.
Agreed. So maybe a simple way to put it would be, we would say direct operating costs are costs that are linked to the usage of the building and the density of that usage, whereas your overhead costs are actually, you could call them head office costs. So their costs incurred whether we're actually physically doing stuff at the residential property or not. Like you mentioned, accounting fees, legal fees, telephone bills, travel expenditures. So essentially just head office costs. However, we should note that there is a gray area there because some direct costs are incurred whether we're operating the building or not. So I'll give an example. Insurance. You know, obviously, if we had a building of 100 units, whether we had 10 units occupied or 1 unit occupied, we'd still have to pay our insurance premium. And likewise, rates and taxes is also a bit of a gray area because whether the building is fully occupied or not, we still have to pay our rates and taxes. And I think we all learned some interesting lessons from the COVID experience where the landlords were petitioning to City of Joburg on relief on rates and taxes, on the understanding that, you know, at the end of the day, our buildings are not occupied, we're not earning income, please can you give us some relief? So it begs the question, is it a usage-related expense or is it a overhead? I think it's, you know, it's very much debatable. And then there's utility costs, which are traditionally direct operating costs because they're directly related to the usage and consumption of the tenants. However, even within utility costs, we go back to the previous slide where some of them are recoverable, typically water and electricity, but some aren't in the residential space, so i.e. sewerage and refuse. It also depends on the area you're in and the type of business model that you decide as an operator, whether you're going to recover sewerage as part of your water recovery or not. But some landlords only cover the water portion and some landlords cover both water and sewerage. And likewise with refuse, it's also debatable. Do we have any property managers in the room who could maybe add to that? Mohammed, I see you mentioned tenant placement and collection agency costs. Agreed. So Mohammed, what would you call that? Would you call that a direct operating cost or an overhead?
Hi, can you hear me?
Yes.
Can you hear me?
Yes, I can hear you.
Yeah, it's the placement cost will be a direct operating cost, and also the collection as well. So because that's an ongoing experience that you have, especially if you're not a owner, landlord, manager, you outsource the function.
And while we're on that, I'll introduce something that we should all be aware of, that the tenant placement costs and collection agency costs, when you're putting together your project packaging and your quick scan C, it's very important to think through that because you should understand, is your tenant placement and the agency costs, are those going to be all encompassed in your project management fee? So if you're negotiating with your project manager and they're quoting you a fee of 8% of your gross rentals, what does that include? Is it just rental collections, but does it also include them doing the leasing? Who's responsible for the lease fees and the tenant placement commission? So all of that is important to understand up front because it informs how you populate your direct operating costs in this QSC as we'll see now. And an important point to remember there in the slide is that only include incremental costs for a specific project. Obviously, that is relevant to applicants who already have existing portfolios. Whenever we submit the Quick Scan C, it's for that specific project. So we don't include legacy costs, which would really be talking about your overheads. So existing overheads we don't include, we include the, call it incremental overheads for this specific project. Correct, sorry, I missed that you're a finance manager. So I'm hoping that you'll help me out here and add and elaborate maybe where I'm not giving enough detail. So we started off with understanding what the income statement is all about. It's how money comes in and how money is spent. Now we move on to the balance sheet. Very simply, the balance sheet is a snapshot of the company's financial position at a specific point in time. And perhaps I'll take a step back there to say an income statement is a record of the performance over a period of time. So typically 12 months, can be also 6 months, can be 9 months, but typically income statements are reported as 12-month periods. However, a balance sheet states where the company is at a specific point in time. So for example, if you have a financial year end that is June 30th, what it's showing you is at the 30th of June, this is what our company looks like from an assets and liabilities and equity point of view. And I think an intuitive way of understanding what the balance sheet is sorry to repeat it again, is really how does capital come into the business and how is it employed in the business? So if we're thinking about capital coming in, it can either come in through equity, so funds from shareholders, or it can come in through debt, through borrowed money. Once we've got that capital, we then need to employ it in the business. And typically we use that to create assets. And that's why if we go back to the classic formula in accounting on the screen there, which is O equals A minus L, owner's equity equals assets minus liabilities. So if we swap it around, assets equals owner's equity plus liabilities. Capital coming in through equity, capital coming in through debt, i.e. liabilities, equals how you employ that capital to create assets. And remember, it's always at a specific point in time. Do we have any questions on that in the room? Okay. So breaking down the balance sheet. Start off with assets. Fixed assets, current assets. Fundamentally, the accounting distinction, if we just simplify it, is how long those assets are held for. So the fixed assets are assets which are purchased and can't be converted into cash immediately. And that immediate definition is a period of 12 months. However, if an asset is effectively liquid, and i.e. within 12 months you can convert it into cash, we'd call that a current asset. And likewise with liabilities. Your long-term liabilities are any liabilities or debt, financial obligations, which only become due and payable after more than a year, whereas your current liabilities would be anything that you have to pay to creditors within 12 months. So an easy example of current liabilities if you had a revolving credit facility, whereas long-term liabilities would be if you had borrowed a mortgage to obviously purchase your property, whether personal or through your business. In shareholders' interest in share capital, very intuitively, all that is the equity capital that the shareholders, i.e. stakeholders who own the business, have invested into the company. If you're listed, you would call it company stock. However, if you're not listed, it's still called ordinary shares, but it's really the capital that has been invested through the owners of the business. Before we move on to capital expenditure, because now we're moving on to a different document now, which is the project-specific document. And I think we've covered the terminology around the balance sheet and the income statement. Maybe I can see if there's any questions in the room just to elaborate on some of those terms. Okay. So now we're moving on to documents that are specific to the development projects that we typically think about when we're applying for the QuickScan C. And these would be seen in what we call the feasibility costing. Later in the section, we'll go into a bit of detail about the feasibility costs. However, in that document, you'll typically see development costs, land costs, building costs, and professional fees. Let me just go back here. The development costs are the total costs of the project. So including your land costs, building works, wet works, which then defines your total construction costs, your professional fees, contingencies, escalations. When all of that is included, it becomes the total development cost. And then the land cost is obviously a component of the development costs and includes the cost to purchase the land, the transfer costs, VAT if it's applicable, and also the cost for the geotech and the legal costs. Henry went into a bit of detail yesterday about how important it is to ensure we always do a geotechnical investigation. And I can only echo his sentiments because we've had a personal experience of this in our very first residential project when we were, unfortunately, I think there's a term called clever by half. We were too clever for our own good. And to save money, we didn't do a geotech. We just went to council and we asked them for an area geotech. And they gave it to us and they told us that these are okay conditions, no silt, no clay. So effectively we costed our whole project, assuming we could do normal strip puttings at very shallow depths. Our project budget was approved, going through the different committees. This wasn't through Schwab, but it was through another agency. And then we had to go to tender. So in order to go to tender, we had to do a formal geotech so that we could do our structural drawings. Lo and behold, the actual property geotech found that there was clay. So we couldn't do strip puttings and we had to do raft foundations. And it added a considerable percentage to our total development cost, which the funder said, well, too bad. You have to find a way to fix to prop that up. So lesson hard learned, we would definitely advise that it is definitely worth doing the geotech as soon as possible once you are sure that you're committing to the project. Building costs, very broadly, these are the actual construction costs, and the QSs you'll know what those are. They include your wet works, everything that essentially the appointed general contractor would be appointed to price. Professional fees, this is a budget for all the consultants who help you as the developer / applicant to put your project together. This includes architects, structural civil engineers, quantity surveyors, town planners, project managers, sometimes financial advisors. And typically they would be paid a fee pool, which is a percentage of your construction costs. So we should just be clear that it's a percentage of the construction cost, excluding land and excluding what they call developers supply and excluding financing items. So purely what is the construction cost. So you can almost think about it, all the designed elements and managed elements is what the professional fees are based on. Do we have any of the engineers and QSs who maybe want to add a little bit to that in terms of how they would define what the professional fees are? Or do you think I gave a fairly accurate description? Okay. And so in a affordable housing and in a social housing project, typically the professional fees would range between 8.5% to 12.5%. In other different projects, it can range between 10% to 20%. The fees are normally regulated by industry boards like the Engineering Council, the Architects Council, QS's Council. And then it's up to us as applicants or developers to negotiate with the consultants to find a middle ground where we can make the project affordable, but also it's still worth it to the professionals. So, it's a very balanced act that we need to be understanding of the fact that our project costs are tight and the margins are thin. However, at the same time, the professionals are running a business and they need to be able to also sustain themselves and need to be motivated to give you the full service that you need in order to get you over the line. So funding. Essentially, I've covered a little bit of this in terms of how capital is raised in a business. How does the capital come in? Either through equity or through liabilities. And essentially, that funding can also then be broken down into short-term and long-term funding. In our space in social housing, if we're talking purely about the debt funding, the typical funders in the market would be NHFC, Natural Housing Finance Corporation, National Empowerment Fund. There are other funders that are slowly coming onto the market, but also to an extent, also we have the traditional big four banks, your Nedbanks, Absa, Standard Banks, FNBs. But they would be the funders for the long-term debt and to some extent the short-term debt where there are perhaps bridging facilities required. The funding that we define as equity funding would be slightly different, and that would be up to the business to raise equity from their shareholders or from other investors. So unpacking the different sources of funding. We've discussed some of this already. The equity, this is normally from the owners of the business or investors, and we call it the owner's equity. Typically, the requirements from SHRA is that it can be in two forms. Proof of cash in the bank, so cash equity, or if the business owns the land or the building that you're proposing to develop on, should that land or the building be unencumbered, i.e. it's uncommitted, there's no liens over it, and unbonded, then that can be recognized as equity contribution by the applicant. And it's also important to note that ODAs, so other delivery agents, are required to contribute 20% of the total development cost as equity. However, if you're applying as a social housing institution, there isn't this requirement to contribute 20% equity. But you'll see as we do some of the practicalities of the quick scan C that it's not always a clear case that just because it's an SHI that you would not have to provide equity in order for the financial model to work. The next source of funding would be debt funding. That comes from the commercial lenders. We touched a bit on those, the top four banks, NHFC, NEF, and what they would normally assist with is the senior debt. So when we talk about senior debt, it's a term that's often used in the finance world, but all it means is it's the highest ranking debt. So in an instance where we've raised capital funding, some from equity investors and a portion from debt, and in that debt we've raised senior debt, let's say from Standard Bank, should anything happen to our business and we are forced to go to liquidation for whatever reason, the first person who ranks highest in the waterfall of who gets paid out first would be the senior debt lender. And that's why they call it the senior debt. And for that, we'd typically be required to obtain a term sheet, which would stipulate the terms of the debt. What is the value that you're borrowing? What is your repayment term? Is it 5 years, 10 years, 15 years? What is the interest rate? And also what are the arranging and commitment fees? Then the other source of capital is the grant funding, which we get from the SHRA, and which is why really we compile this quick scan C. Its all-encompassing term is called the Consolidated Capital Grant, but it's actually made up of the restructuring grant and the provincial subsidies. And I'll detail just now how those are split up, but now they're all basically encompassed into one consolidated capital grant, and you sign one agreement with the SHRA when you achieve it, when you are granted this. And then there's also donations, which applicants can get. Typically, that would be in the realm of social housing institutions. And those are effectively also sources of capital. And so if at this point we take a step back and we think about this equation of owner's equity equals assets minus liabilities, just thinking through this equation, we can think about if you get the grant, and obviously when you sign your consolidated capital grant, there are terms to it that you have to meet in order for it to be unconditional. So they call it conditions precedent. And there's also a milestone called financial close. And at that milestone, you have to have met certain conditions. However, let's assume you've met all your conditions, you've fulfilled all your obligations. And remember that with the grant, you aren't specifically required to pay back that grant. So there isn't a financial obligation, but I'll state there isn't an obligation once you have fulfilled all the conditions in the consolidated capital grant. So I want to throw that to the group to say, having explained how the formula below works, where owner equity equals assets minus liabilities. If you're getting a grant, what is this grant? Is it equity or is it a liability? I don't want to pick on anyone, but I really want us to unpack this one a bit because it's quite important for understanding how everything comes together. I see Joel. Can I maybe ask you to give us your thoughts? Mohammed says, is it equity? Joel says, it's a liability. So both of you are on the right track, but let's look at this equation. It says equity equals assets minus liabilities. A liability means it's got a financial obligation. So i.e. you have to repay it, there are terms to it. So remember I'm saying, once you have met all the conditions in your CCG and there's now no longer an obligation to repay, would you agree that if you're saying equity equals assets minus liabilities, you're getting this grant, you don't have any liabilities against it. So effectively, if we follow the formula, it means it's equity. But it's important to understand that it's only equity once you have fulfilled all the conditions that would intentionally result in you perhaps not being able to continue to use the grant. So for example, if you drew down on some of your grants at stage 1, which is called conditions precedent, and then for whatever reason, you defaulted on some of your other obligations under the contract, and you didn't meet financial close, you'd be required to pay back that grant. So in that instance, what is it? In that instance, it would be a liability then because there's an obligation to repay it. So I think on that, I just wanted to illustrate how informative this equation is because it really helps you understand what is your equity and what informs why it's equity and what is a liability. So still on funding, we mentioned earlier that we'll talk about how the restructuring capital grant is constituted. It's constituted in two parts. The consolidated capital grant is constituted. It's two parts, the restructuring capital grant and the provincial subsidies. The RCG, restructuring capital grant, is typically 155,000 per unit, per qualifying unit. And that's important to note because you're only eligible for a grant on qualifying units. Criteria being self-contained dwelling units. So it must have its own kitchen, its own ablution areas, and its own living and bedroom areas. Can be a studio unit though. And also it must be a minimum of 30 square meters. So for example, if in your design you had a few self-contained dwelling units, maybe 1-bed, 2-bed studios, but then you also had rooms where it's just a living area and a sleeping area, but with no kitchen and no bathroom, those would not qualify for a grant. And likewise, I think Henry mentioned yesterday also that the capital grants only apply to residential dwelling units. They don't apply to any of the commercial elements of a building. So if you've got a mixed-use development, you can only get a grant for the residential portion, and for that residential portion, it must be the self-contained units. The other portion of the consolidated capital grant is the provincial subsidies, which is awarded by each province, and that quantum is 116,000. And this relates to what Henry was talking about yesterday, relating to the presentation to the provincial steering committee, whereby they have to authorize and approve your project and thereby give consent to the SHRA to award the provincial subsidy as part of their consolidated capital grant. Share capital, we've covered a lot of this already, which is the equity that is contributed by the owners of the building, of the project. It can also be through donations received by the entity, typically as an SHI. But the important element to note here is that the other delivery agents are required to satisfy the condition that they're contributing 20% of own equity to the project. And then there's also the long-term debt, which you need to get a letter of confirmation, either a term sheet or just a letter of intent from a senior debt funder, just indicating that, one, they support your project and the potential terms. And you do actually need some of the terms that would be in the term sheet, because you need those to populate the quick scanty, as you'll see shortly. So we actually moved through that faster than I thought, and we can take 5 minutes just to have some questions, a general chat, and I'd encourage you to ask the questions on the chat, or also to speak directly to us. Let's go through some questions that maybe you've been holding throughout this session. Henry?
So, one of the questions that has been raised is MES funding, whether that is considered as equity.
Yes. So the mezzanine funding, and it's important to really define what mezzanine is. So the mezzanine funding is a source of capital which sits between debt and equity. So remember, we mentioned that the senior debt is the funder who has the first right of claim should anything go wrong. And then the equity holders, i.e. the investors, the owners, they have what we call a residual claim. They're at the bottom of the waterfall if anything goes wrong. And effectively, that's why they get the biggest stakes, because they take the most risk. It's called a residual claim. Mezzanine sits somewhere in the middle. So it's a form of debt where you do have an obligation to repay. However, you only repay when there is sufficient cash flow to repay that debt. So in the financial world, they call it sweeping cash flows towards the financing facility. And as an example, if you had operating income in your project of 10 million Rand, and your debt service to service your senior debt was 6 million, and therefore you have free cash flow of 4 million, that 4 million would be used to service the mezzanine debt. However, if in the next year, for some reason your vacancies increased, or we had COVID and you had a lot of arrears now, and your operating income dropped to 7 million, remember the senior debt funder, they're non-negotiable. They still want you to repay the 6 million. So now all of a sudden your free cash flow is only 7 minus 6, which is the 1 million. Now, that 1 million must service your mezzanine funder. So for example, if your mezzanine funder had an installment of 4 million, you'd be short by 3 million. And that's why it's important to understand how mezzanine works. It doesn't necessarily mean that every year the debt funder, the mezzanine funder, can come knock on your door and say, no, you owe me this coupon. They understand that you can only pay them based on cash sweeps, any free cash flows that are available. Where do we get this mezzanine funding? So there are various sources of mezzanine funding. It is, I think some of the funders that we have listed on the presentation could help. The NEF. I'm not sure if the NHFC would be able to assist on this, but it is, where our advice would be to engage all of them because, their funding models are consistently changing depending on what's happening in the market. However, you should be able to talk to NEF for mezzanine funding and potentially some of the commercial banks.
So just to add there, in terms of MES funding, it's important to understand that generally your MES funding is very expensive in terms of its pricing. So when you go into an NEF or a TAF or any other funder, it's normally priced at prime plus 3 or 4%. So you need to understand that MES funding is generally very expensive.
Thank you, Henry.
Hi, Khomotso, it's Mohammed here. The use of preference shares, what is your take on that?
So
to bring in investors, on the equity side?
Yeah. So, I haven't come across one where, and Henry, have you come across one where they've used preference shares? What
No.
we've seen mostly is just the shareholder loans, which essentially would typically serve the same function as preference shares, but I haven't come across one where they've specifically issued the prefs in the business.
Yeah, I think it's to do with the redemption, just to make it easier for, external parties to invest in without having to sell off equity directly. So that would be something maybe to think about. So that doesn't dilute the shareholding requirements.
Agreed.
So on that, yeah. So on that note as well, I mean, what type of entities are there? So, what are the legal entity forms that you guys look at?
Henry, I missed
Hold
that.
So basically what you have is remember that in terms of SHRA, they use two entities. Either you are an SHI, which is generally an NPC or NPO, or you can be a PTY, but a number of those PTYs fall within the ODA category, which is your other delivery agent and generally a private company. And also remember that, and I think this is very important, remember that when you go to SHRA, right, you are going into this marriage forever. So if you're an SHI, all what you have to do is you are going to be managing this asset for the next foreseeable future. So there's no exit mechanism. Right? You are in for the rest of your life. And that is important for everybody to understand that that capital grant, you can't then decide to say, you know what, I'm now going to exit and I need my money. If you are going to do that, you will need a SHRA to come to the party. You need to approach to them and you say, this is what I want to do.
Okay.
Khomotso? It's Puti here.
How are you?
I just want to take you back to the equity part that you spoke about. I've got a question there. In terms of the equity, you spoke about the 20% that ODA needs to have it needs to have as of 20% of the project value. So I want to understand, is that the money that you want to see in the account or a financial agreement with a financier, is it sufficient enough?
Yes. So, if, for example, you were treating it as the mezzanine, the letter of intent from the mezzanine funder would be sufficient at the initial application. But obviously, part of the conditions of the capital grant would be that you'd have to enter into formal agreements with that financier.
Okay.
So, whether it's your mezzanine funder or whether you are raising that capital through investors, through shareholder loans, you would have to have in principle terms and in principle agreements to submit at your initial application.
And then my second question is that, does it matter how I raise my equity, or you guys have got maybe strategic ideas that we need to raise equity on? Because I'm thinking of crowdfunding. Is it acceptable in Shura, or it's not?
Well, I mean, I guess that's always the classic challenge with advances in technology, that I don't think the Shura committee has, and I stand corrected, I don't think they've had a case of that yet. However, to the extent that through the crowdfunding platform, you're essentially just raising capital, I would venture that you should be able to present it, but you'd have to think about the practicalities of getting everybody to understand it, what the terms are going to be. And remember that this is going to be reviewed by an investment committee. So those might be some of the challenges in terms of getting that through the system. But from my understanding of the crowdfunding, is all you're doing is really, you're just raising the same thing, cash equity from a pool of investors. Is that answering your question?
Yeah, my question is answered. So it's treated case by case.
Yes, and I think, like I'm mentioning, that advancing in terms of structures, you'd have to put it in front of your dedicated transaction coordinator at the Shura, and they would then advise you on how you could tackle that.
Okay, now I'm answered. Thanks.
Sorry, Komo. So also to mention in terms of equity consideration, let's say you've got land and that land is unencumbered. You can basically inject the land into the project and that becomes your equity contribution. But for you to do that, you need an independent valuer to come up with the value of that land.
Okay.
Zane?
To you, Henry. You spoke about the long-term marriage. Now, I want to understand, as an ODA, is that applicable to me as well? Am I in a long-term marriage with you, or is there a certain period that I can actually exit?
Now, remember, whether you are an ODA or SHI, right? You are in for the long haul. But remember, because you are an ODA, right, you can basically have profits. So you can take profits out, but limited to your equity contribution. Maybe Kamutso, you need to, if you can just come in and give an example of what happened with the project in Durban at that seminar with the ODA.
All right. So, I mean, this is it's quite a, from the Shura's point of view, and in terms of the capital grants point of view, it's very clear. If you have a project and it's funded, call it 60% through the grant, and the funding that is raised through the applicant, whether it be through equity and debt, is the 40%, the CCG says that you cannot sell the project you cannot sell it without the consent of the Shura. And obviously then you're also required to sell it to another social housing institution or an ODA. However, the profits realizable on sale are only the profits on the applicant's contribution. So the equity and the debt funding, however that portion is constituted. So it's not that you would be realizing the profits on the full development, because a portion of that is related to the grant portion. So it's, the question always comes up, but however, it's quite stipulated quite clearly that what you participate in is the equity and the debt funding that is raised by yourself as the applicant.
What's on that
Promoter.
note? Then, on that note, where does the balance of that capital go to then?
Mm.
So it's actually, it's an interesting one here, Henry, because there's been very few case studies of it. However, we can only really work on what the letter of the CCG says, which is that whatever the profit is realized, a portion of that, if it's 60%, was funded through the grant. A portion of that is obviously grant funding, and that would implicitly go towards the SHRA and be reallocated through further pools of funding. And you as the ODA or the applicant would only get the 40% of your capital that you contributed. So i.e. whatever upside is realized on sale, you're only getting the 40% of that.
So, Khomotso, basically what you're saying is that as an ODA, I would not have 100% ownership of the asset.
You do have 100% ownership of an asset, but it's subjected to a notarial deed registered against the asset upon signature of the consolidated capital grant. So you own it, you have effectively the full bare dominion. However, it's restricted by this notarial deed.
Okay.
Promoter.
Is that
Yeah, it's Zania.
Jane?
I want you to clarify my understanding here. So, of your total development cost, between 60 to 70% is from the grant funding, being the SHRA and the provincial grants. Then 20% you're required to provide owner's equity, either in the form of cash in the bank, unencumbered land value. Okay, so that brings you to between 80 to 90% of total development cost, and then your other, then the remaining 10 or 20% that you need to get senior debt funding. On the senior debt funding, that comes from either NEF or the NHFC. On that debt funding, do you know whether the NEF or the NHFC, what are their requirements? Do they still need like some form of equity contribution to them to raise that capital? So just say your project's 100 million, you need 20 million now from the NEF or the NHFC. Do you still have to put maybe 10 or 20% down with them in the form of unencumbered equity to raise the balance, the 16? Or do they give 100% senior debt funding upfront?
So remember that the funders look at the whole project. So they wouldn't just look at their little portion in isolation. They would look at the full project cost of 100 million, understanding, like in your example, that 70 was a grant, 20 is being brought in as equity, and their 10 million is just that's the last senior debt portion. So they wouldn't ask you to contribute any more equity aside from the 20 which you have already contributed. So they look at the total project, not just their portion in isolation. So
okay, but obviously if you don't repay, then they have first right over the asset as senior debt funders.
Agreed.
So that is their security then.
Agreed. So when you
cool.
do sign the CCG, you would need to sign the notarial deed of restriction, which is in favor of the SHRA, basically stipulating the conditions upon what can happen on sale of the asset, of the property. And then you'd also need a permission to register the notarial bond in favor of the senior lender. So which is what creates that mechanism so that the senior lender ranks first in terms of claims.
And then secondly, just from your experience with like the NEF and the NHFC, how efficient are they in terms of senior debt loan applications and processing those?
I think I'll be careful on answering that one and say that, at the end of the day, we have to understand the nature of the institutions, but we, in our experience, we've had a mixed bag. We've had some good experiences and sometimes not so great. And what I've realized is it's also aligned to their capital position. So sometimes they're slow, not because they're inefficient, because around how they're funded at that point in time. And sometimes they are efficient when they're well capitalized. So, but you know, overall, the experience has been okay for us. Henry, I don't know if you want to add to that.
If you're an ODA, they tend to be more favorable to ODAs because of the equity contribution. If you're an SHI, because there's limited equity, you might find that you know, the time that it takes, you need to actually convince them because of the fact that there is minimum equity contribution. But generally for ODAs, they have been good and they've been able to come to the party.
Okay, noted, thanks.
And what is also interesting is that if you look at some of these DFIs, right, they actually want the borrowing entity to sign surety ships. Now, if you're an SHI, and SHI hasn't got, you know, shareholders, they've got a board. So that's why you find that they are more, they prefer to deal with ODAs. So just think of that in terms of your capital structure.
Sorry, Khomotso, can I just ask a quick question?
Douglas?
Yeah, sorry, Mac. I'm still trying to get my head around that grant funding, because I understand the first phase of it, until all the preconditions are met, it remains a liability, right? But then once all the preconditions are met, do I assume then that turns into equity? Because it's all in the context of, you know, I can't sell, I don't own this thing 100%. I don't know whether my question is making sense. I'm just trying to understand the accounting treatment of that grant in the long term.
We actually received quite a good comment in the chat on this, and I suppose that's the purpose of some of these discussions, that there are different specialists in the industry, and we do have Joel who clarified us a bit on that in terms of how IFRS treats it. Joel, maybe you could share with the group. Sorry, Douglas. So the comment from Joel was that the IFRS treatment actually, even though intuitively, if it has no obligations, we would think of it as equity. He mentioned that under IFRS, it would still be strictly treated as a liability. So what I'll do is I'm going to move on a little bit, and then when Joel comes back online, we'll ask him to share with the group and just unpack that up for us a little bit, if that's okay.
No, that's fine now, because I think I just need to get the accounting treatment of that grant clearly in my head. Thank you.
All right.
Khomotso, one more question.
Puji?
Yes. As an ODA, right? What's the, let's say for the FX project goes well and becomes successful and kicks off the grant and starts generating an income. Am I allowed to actually use that asset as a leverage to actually build up equity for the next project?
So if it's unencumbered equity, there should be no reason against that if you have free cash flows after you've serviced all your expenses and you've also maintained your maintenance provision. Building up that cash flow as equity towards the next project, that's organic equity generation, which I think the SHRA would support wholeheartedly.
All right.
So I'm going to move on a little bit just so we start getting into the next section. So I mentioned earlier that there's what the SHRA calls key performance indicators. Before I go into the slides, I'll mention some of them. Number one, you need to make sure that when you allocate your composition of rental units, at least 30% of them qualify or allocated to the primary beneficiaries. Henry touched on this yesterday about the allocation between primary beneficiaries and secondary beneficiaries. The main distinction being primary beneficiaries are households with incomes below 5,500, and then secondary beneficiaries, households with income between 7,700 and 15,000 per month. You also then need to make sure that you meet the IRR requirements. You need to make sure that you meet the maintenance reserve requirements, which is that you need to reserve 1.02% of your total capital costs as annually as maintenance. And then you also need to make sure that you meet your minimum debt service cover ratio. And the last one being that your residential operating costs for the development annually need to be a minimum of 1,350. However, you'll see that in the model, they actually allow it to be a minimum of 1,300. So let's unpack what these key performance indicators are. Debt service cover ratio. Before I even go into the definition or what's on the screen, I think that image over there on the right-hand side tells 1,000, it's a mouthful, because it's effectively a measure of how much cash flow you have to service your debt before you start drowning. And if you think about the formula, all it is it says gross income less your operating costs. And if we go back to our earlier slides, that means we're talking about operating income. Gross rent, less vacancies, less direct costs and overheads gives you operating income divided by your total debt service cost. So for example, if we're required to make sure that we have a minimum ratio of 1.3, what that effectively is saying is our operating income needs to be 1.3 times more than the total costs we need to pay towards our debt, including interest costs and principal repayments. So it's effectively telling us how much margin do we have before we start drowning. So for example, if your debt service cover ratio is 1.5, it means effectively you've got 1.5 times operating income as compared to what you have to pay towards the bank annually. Whereas if your ratio is 0.8, it means you only have 80% as operating income as compared towards what you have to pay for your debt. And it means you're drowning. So it's the margin before you start drowning. And in the model, we're required to maintain a debt service cover ratio of 1.3 times. The internal rate of return. I'm going to throw this one out to the group because it's, in my experience, even amongst seasoned bankers, it's a very difficult concept to explain in simple, intuitive terms. Does anyone have a definition they want to volunteer? A simple definition for
my understanding is that it is if one take away all your expenses and whatever based on your actual return. So if, for instance, if Frans said we want a 10% internal rate of return, then whatever return on investment there would be. For instance, if it was 15%, then it would, that 10% would need to be covered from there, based on what you guys contributed and what has been agreed on. That is my simple understanding. I don't know if it's correct.
So I'm going to add on to that and say there's different terms. There's what you'd call a building yield. There's a capitalization rate, a cap rate. I think Henry briefly mentioned on these yesterday. And then there's this concept of IRR. All three of them really talk about return on investment. The building yield, all it's saying is the expected income for the first year. And I go back to operating income. So that's why I said that that line item is the most important, because it really drives a lot of the different metrics in understanding some of this financial terminology. So the building yield, all it is operating income divided by development cost. That's the yield. So it's a return on what you invested in order, what you invested as total capital to develop your project. Then the cap rate works the same as the building yield. So it looks at operating income for 1 year divided by development costs day one, or purchase cost if you are purchasing the building. The only difference between the building yield and the cap rate is that building yields are specific to one project, whereas cap rates are defined by the market for that specific type of property. So if we said that buildings in the CBD trade at a 13% yield, by not being specific to a building, what we're talking about is a cap rate, because in that area, for that type of asset, we're saying that the yield expected is 12%. And that would be the income on the property divided by the purchase price or development cost. Whereas if I said, I'm looking at a specific building and I've done my numbers and the yield on this is 12%, that would be the specific property's building yield. The IRR is slightly different. It's also a measure of return, but it's a measure of return of capital invested over a period of time. So it's not necessarily just operating income in year one. It would look at an investment horizon, i.e., how long do you anticipate to hold the investment for? The QuickScan C is a 20-year model, so it'll give you a 20-year IRR. And you'll see as we go into the model that even though the summary number is a 20-year IRR, it's calculating the IRR on an annual basis. So as you move forward in time, it becomes 19 years, 18 years, 50, and so on until you get to 10 years, 1 year. But essentially, all the IRR is, it's a measure of return of cash flows earned against what you invested into the project. I mean, that's the easiest way and the most intuitive way to distinguish the IRR, that it's a return over a specific period of time, and it's a return on capital invested, similar to how we've illustrated it in this diagram over here. Whereas your cap rate is the return based on operating income in year one forecasted against what you spent on the development. It's a market-driven return. And then the building yield is a building-specific return, whereby it's forecasted income, operating income for year one divided by the development cost. And it's obviously, the IRR is expressed as a percentage. The Schroer model uses a benchmark of prime as a benchmark for calculating the IRR. And their requirement is that it must be prime plus 4.5%. We touched on this a little bit yesterday, that the model still assumes prime at 10%, and that's fundamentally just that they've said that applicants should keep it there. But should you feel that you need to change it, or you have a rational reason for changing it, you are advised to contact the Schroer and discuss with them and present the case as to why you want to change the assumption on prime. But the margin above it remains the same at 4.5% above prime, giving you an IRR requirement of 14.5%. And I see that we just didn't change that prime number there, but obviously now prime is at 7%. Then we move to operating costs per unit per month. So we've discussed a lot about what the direct operating costs are and what the overheads are. And actually, before I move on, do we have any questions around those two metrics, debt service cover ratio and IRR? Can I just have an indication that everybody's still comfortable and we're still together? Maybe we can just put it in the chat. Okay. All right. Thank you, Douglas. Thank you, Trudette. So now we're moving on to operating costs per unit per month. What this is it's effectively the total sum of all your operating costs, both direct and overheads, divided by the total number of units. The criteria is that the total project must have a minimum of 1,350 per unit per month, but you'll see that the QuickScan C in its current version actually does allow you to have a minimum threshold of 1,300 per unit per month. And I'm going to pause a little bit there because this is quite, it's a foundational point in understanding how you allocate your units. We'll see when we get into the revenue allocation that because the income bands are regulated and the minimum and maximum rentals for each specific income band is specified, what you'll see is if you calculate it across the 5 income bands, it implies that the average rental per unit, if you're looking at all your units, comes out between 2,900 and just over 3,000. Now we can think through that. If your minimum residential operating costs must be 1,300, you can already see that what it's implying is your operating costs as a percentage of revenue. The ratio is sitting at around 45%, depending on how you actually set your rentals in the revenue allocation section. And that 1,300 number, there's quite detailed metrics on how Schwa arrived on that, and it's through benchmarking in the market. And they've arrived at an estimated direct operating cost of 950 per unit per month, and then 400 for overheads. So it's quite important because off the bat, what it's saying is that the operating costs to gross rental ratios is around 45%. But also important to note is a big portion of that is your maintenance reserve, which you're required to hold as cash. It's not necessarily that you'll be actually spending all your maintenance reserve. You'll be holding it as a provision on cash on your balance sheet. Then there's the maintenance as a percentage of development cost. So what you're required to do is you're required to compile a 10-year maintenance plan, which includes reactive and planned preventative maintenance. So reactive maintenance would be everyday maintenance, replacing bulbs, things that you need to turn around within 2 to 3 days. Whereas your planned preventative maintenance would be major items, paintings, roofing, retiling, which you provision for looking over a 5-year or a 10-year program period. And that 10-year maintenance program, the average of all the reactive and planned maintenance annually needs to equate to 1.02% of your total development cost. I think many of us at some point might say that's a big number. However, the rationale behind it is it's based on benchmarking that they've done, where they've looked at over term what would be sufficient to ensure that the applicants and the ODAs actually build up enough reserves so that they don't run into cash flow crunches where major repair items come up and you just don't have the cash flows for it. Then the development costs. This is less of a key parameter. However, it's important to note that the total development cost per unit is everything, financing, land, construction, everything together, divided by the number of units. And what we've seen in experience is that the golden number sits between 400 and 440. If you're pushing it, 450 per unit. And because above that, you then start having challenges if you are an ODA and you're raising debt, and perhaps also if you're raising some of your equity as mezzanine, so it still actually also impacts your debt service. You'll have a problem in terms of your debt service cover ratios. But the bigger issue is if you're SHIs and you are not contributing any equity to the project, then once you start going beyond that 400 to 440 mark, the ratios no longer work, especially for the debt that you'd be raising to plug the difference between your development cost and what you'd get as a grant. Because the grant quantum is consistent, whether you're applying as an ODA or an SHI. It's still the 271,000, which is the sum of the provincial subsidy and the restructuring capital grants. Then the vacancy, we've discussed a bit about what is vacancy, where does it fit in? Is the opportunity cost of income not earned through units being unlet. And in the model, you'll see that the assumption now is 10%, 7%. However, some versions of the model have 10%, so it's also important to make sure that you always have the correct version of the model. Most SHIs at the moment, what we've seen are varying between 5 to 10%. However, some of the very, very strong operators with great experience can decrease all the way down to 3%. So if you do feel that you have reason why you want to use a lower vacancy assumption, you can consult the SHRA about that. Then the bad debts provision, all this is it's a provision for arrears which are written off. And the model requires that you have a minimum assumption of 2%, but you'll see that stock standard, when you get the template, it'll be sitting at 3.5%, but you can reduce it down to 2%. And as I mentioned earlier, the strong performers in the industry are slightly lower than that 3.5%. Cost to income ratio. We've touched a little bit on this. And this goes back to if your total operating costs are required to be a minimum of 1,350 per unit, but your average rentals are sitting between 2,900 and just over 3,000. It can be slightly lower than 2,900 depending on how you set your rentals. Then it means that your cost to income ratio is already going to start off at between 45 to sometimes just over 50%, which is very important in understanding why issues around the debt service cover ratios would arise, because you have less operating income to work with off the bat. So in that section, I think we've covered the key performance indicators. Henry, do you have any questions that you think I should address at the moment? Is there anyone who would like to raise some questions?
Maybe, Komoto, what is key is that number, is that development cost number. We have seen people that have come to the market with units at about 500,000. Now, if you are an SHI, you are going to find it difficult to be able to get those key financial performance indicators green, because that 500,000 per unit is just way, way, way above what SHRA would actually expect. So you need to sit with your team and do a lot of value engineering and try to bring those costs down. Kes, are you there? Can you hear us?
Yes, I'm here.
Did you hear the comment that I've just made?
Loud and clear. I'm glad even my QS is also here. She's heard loud and clear.
Okay, all right.
I'm Komoto.
Puti?
Yeah, just speaking on the vacancy percentage there, isn't that informed by the demand study?
Yes. So it's the demand study would obviously inform the potential of the market, and it also inform, actually, you'll find that your senior debt, your funders would want you to put together like a occupancy letting schedule, which talks to how fast you'll fill the units. However, the actual vacancy, because it's not just a year one or year two vacancy, it's a long-term vacancy. It's informed by one, the strength of the market, which relates to what you're saying, the demand study, but also the performance of the actual operator, how you manage, how you lease, I guess, the quality of your property management. That also informs that vacancy.
Okay.
Puti, does that answer the question?
Yes, I'm answered. Thanks.
So there's also another question. Are we free to adjust the mix of units in order to fall within the SHRA KPAs?
So you can adjust the mix of units as long as you're within the required income bands allocations. And you'll see earlier that it's that 30% must be primary beneficiaries. And of that, 10% are the band one, so households earning less than 3,500, and 20% in band two, households earning less than 5,500. And then it's 20% for band three, 20% for band four, and the residual 30% for the highest income band, households earning less than 15,000. So you can move around as long as the total income spread, and you'll see that now when we go into the model, is within those metrics of 10, 20, making 30% for primary, and then 20, 20, and 30, making the 70% for secondary beneficiaries. Are we comfortable to move on to the next section?
Can I just ask one question? The prime lending rate is 7%. And am I correct in interpreting that the model shows 10%?
Correct.
Yes.
And so how do we balance back our figures of our current prediction around the capital and the investment and the lending and repayments to match what's on the model? Will we dig deep into that when we get into the model?
So you're 100% correct that there's obviously going to be a mismatch between if you have a separate financial model using current prime rate as your benchmark rate. However, what the SHRA has said is that they haven't changed the template at the moment, because their view is that this is a long-term model, and it's likely that prime rate will move around, maybe not in the next 12 months, but possibly in the next 36 months. So they're taking a long-term assumption. And also remember that in this model, it's not using a fluctuation of prime. It's saying it's 10% for the full 20-year projection period. Whereas perhaps in your model, you might say that you're forecasting 7% for 2 years, and then an increase of 1% thereafter. So the best approach would be what SHRA's confirmed is we should model based on the template at the moment. However, should you feel that you have a strong case for why you would like to change the assumption, they are welcome to discussing that with you. So you'd have to contact your transaction contact at the SHRA and work through them with them on that. But they're not against it. Certainly the feedback we got was we have to stick with the model where it is because it's long term, but we are willing to talk to the applicants to understand what their assumptions are. And maybe that's also a good point that you'll see when we get into the model, there are what they call blue text in the model, which is everything that is inputted by SHRA. It doesn't necessarily mean you can't change those assumptions, but you do have to discuss it with them before you make any changes. And I think,
because
if we take a step,
it can go.
Proceed for it.
No, I'm saying because it does affect the repayment amounts, which forms part of the costing. And based on a 10%, it's going to spit out a higher amount payable.
Agreed. Agreed.
So,
yeah, I think, Claudette, what you need to understand is SHRA is basically taking a long-term view of prime interest rate over 20 years. Now, if you look at what has been the average prime interest rate over the past 20 years, you find that prime would be, the average would be around 11.5%. So what they're saying is for the next 20 years, prime, they're literally saying prime is going to be fixed at about 10%, of which they're being, they're actually being conservative. It's even better for your model to be conservative than for you to actually be bullish.
yeah, thank you.
So maybe just to add on to that, why, if we take a step back and we think about it, put ourselves in SHRA's shoes, if you're receiving multiple applications monthly, if you don't have a standardized template with standardized assumptions, it becomes very difficult to review each application, because then we wouldn't have necessarily an understanding of what the assumptions that each applicant used. Whereas if everything is standardized, and should you want to deviate from any of those standard assumptions, it's up to the applicants to approach the SHRA to discuss that before you change those assumptions in the model.
Yeah, sure, noted. Now, I basically just brought it in. I understand the average and long-term period and all of that. I'm basically just bringing it forward now because of current applications and the the uncertainty of the market at the moment, and we really don't know what the interest rates are going to play out. So I just brought it out just to understand the dynamics around it now. But thank you very much.
Any more questions in the chat, Henry, or shall I move on? Okay, so we'll move on to feasibility costing basics. We won't spend too much time on this because a lot of the details of feasibilities was discussed yesterday in the Quick Scan C, whereby Henry really unpacked what the technical feasibility is. But for the Quick Scan C, we talk about the financial feasibility. So it's a document that is produced by the quantity surveyors, and essentially it gives you a estimated construction and development cost, including the various cost items that would be required and incurred by the project. And often then it also goes a step further and provides the estimated income schedule, should the QS have that from the developer or the applicant. And then they might often sometimes do a sensitivity analysis, which includes an estimated return and risk analysis. Can I maybe ask the QSs in the room if they would like to offer a simpler definition, although I think we've kept it quite simple in terms of what is this QS feasibility document. And maybe I'll just add that it is not necessarily a BOQ. So sometimes we use the word BOQ quite loosely, but the BOQ is the bill of quantities, which the document produced later on in the development planning process. And that document is the document that is typically fairly detailedly priced, and it's something that you would issue out to tender for the contractors to price once you're ready to prepare for construction. However, the feasibility costing is in the early stages of the planning process, and it's developed by the quantity surveyor based on their experience of similar projects and market-related rates for specific items. Do any of the QSs want to maybe add or elaborate where I haven't added enough detail. So we've broken this down in terms of the 5 steps of feasibility costing. First step, estimate total development costs. And we've talked a bit about what this is. It includes construction, it includes land, professional fees, contingencies, everything that will be the expenditure of the project. Then it can go further and it can estimate net income. This is a bit of a blurred line here because some of this work would be done by the applicant / developer in conjunction with the quantity surveyor. And then it also can estimate return on investment. Typically, this would also be the applicant / developer's role with their own model, but they can work with the QS on this. And then to do a cash flow projection to say, this is our development budget. If we use the example we used earlier, the total development cost is going to be 100 million. We are going to have a construction period of 10 months. How are we going to draw down the capital over that period? And then the last step is the risk analysis, which would be doing those analyses of net income, IRRs, but a lot of that would typically be done by the developer. And in the instance of the QSC, those risk analyses are done in the QSC. So the QSC would give us net income because we'd fill out our revenue projections and our operating incomes. And it would give us a return on investment through the building yields, the IRRs, and we'd do a risk analysis through providing us with those outputs of the 5 KPIs we discussed earlier. The quantity surveyor's report gives us the total development cost traditionally, and specifically required so that we can do the QSC is a cash flow projection from the QS. So just to be clear, we don't necessarily need what they call a BOQ to do a QSC. We only need the feasibility costing done by a professional and registered quantity surveyor. So now we are ready to move onto the QuickScan C, the meat of this presentation. We are really running well ahead of time. So I'll take a few minutes here to take some questions. And if anyone wants to stand up and stretch, we can take an opportunity to do that now. However, I'd ask that we don't leave the room because we're just going to be answering questions and then immediately moving on to the next section. So we're not necessarily taking a comfort break, but if you do need to stand up and stretch your feet, now would be a good opportunity. And I'd ask Henry if you can maybe assist me with answering some of the questions that have come up.
Komotsoputi here.
Okay.
Can we go back to the previous slide?
Yes.
Yes. There's this. So in terms of the packaging process for the project, this is the only stuff that you are looking to actually look into you're looking forward to find in the project.
From the QS's point of view, there are other documents, and that's actually my next slide in terms of documents you need to have in preparation for the QuickScan C. But obviously, okay.
I'm actually specifically asking because of what I've actually heard from Henry yesterday. So Henry has actually mentioned that we need to have a detailed BOQ as part of the packaging. And then today you're not speaking about it. So can you just give me clarity there? So
the detailed BOQ would be one of the conditions under the consolidated capital grant. So if you go back to Henry's process, there's the initial application, where you run that whole process leading up to technical assessment and then council approval. Then you are entering into a consolidated capital grant. And in the consolidated capital grant, there's two stages. There's the meeting of CP's condition precedent, and then there's the meeting of FC financial close. For the for the initial application leading up to your CCG, the detailed feasibility costing is what's required. You're not necessarily required to have a BOQ, because obviously a BOQ would mean that you have one appointed through whatever documentation through the POCSOs, your full professional team, which means you're already committing to incurring costs. And you'd also be then effectively, I think some of you would know as QSs that once a client asks the QS to compile a BOQ, the QS can effectively invoice for almost 30% of their fee. I don't know if I'm correct.
You're 100% right. This is why I wanted to ask you right now. So these steps right now, step one and step 4, can it be done without the a signature of a professional QS?
No, so you would need a signed QS to do a feasibility budget, but you wouldn't need a priced BOQ. So that's the difference, that you do need a signed feasibility costing from a registered QS, but not necessarily a priced BOQ.
Okay, then I just from your point, just to correct your point, at this stage, then we'll be spending on those services, because there is no QS, PR QS will sign without getting money for his services.
And Puti, I'm gonna, I'll take you as the professional on that one. I think it's different in the market in terms of what specific applicants negotiate in terms of how far the professionals are willing to run on risk and when they aren't willing to run on risk anymore. But at the end of the day, it is a discussion that has to be had between the applicant and his professional team. Hi, Puti.
There's also a question on the chat box. Does the SHRA use external professional consultants, or they have in-house resources?
So for the evaluation, it is evaluated internally and also by an external consultant to make sure that the compliance is in order. But obviously, as the applicants, we wouldn't necessarily be involved in that. But they do have to get a sign-off externally that the application is in order, which is really part of that whole technical evaluation process. Henry, do you want to add to that, or have we answered that sufficiently?
So basically, I've got internal and external that do the assessments.
Yes.
They normally have those external assessors that then look at your quick scan B and your quick scan C.
Yes. So I suppose that's for independence and compliance, which is quite clear.
So there's another question that has been raised. It says, my partner owns land and we will JV to do the deal as he has no experience in developing the property. I would have bought his land, but it makes more sense to JV initially as it's in an expensive node in Cape Town. May I buy him out at a later stage? I will raise debt to buy him out in year 2 and year 3 after construction. Is this scenario acceptable to SHRA?
So I think that's really a internal capital structuring, as in terms of how you would set up your business, whether you're gonna, I don't know if your partner owns that land in his personal capacity, in his or her personal capacity, whether they own it in a PTY. So there's, you'd have to really unpack that for us and present it to the SHRA. But to the extent, if we use an example where perhaps they owned it in a PTY and you bought shares in that PTY, there's nothing prohibiting that as a structure to present to the SHRA. However, you know, if it was owned in personal capacities, you'd have to think through how you would get that into a PTY. So if you wanted to apply as an ODA, how do you get that land into the PTY without incurring a lot of some of the transaction expenses which would come through purchasing the land, and maybe considerations around if it's an expensive node, would it trigger capital gains for your partner? So it's not a straightforward answer that we could give you, but you'd have to think through, you'd have to present it to the SHRA with the details.
Also, there's also another question. Is there a minimum number of shareholders for ODA?
ODAs are P2I limited, so governed by the Companies Act. And I think, if I remember correctly, the minimum number of shareholders in the Companies Act, is it, I think in a normal P2I, I can't recall it. Henry, what's the minimum?
Minimum is 3, maximum 50.
Okay.
For company, but for if you're a PTY, you can be 1 shareholder.
Okay.
As far as I know.
Okay. So the ODA is governed by the Companies Act.
And what is the forecast escalation rates for SHRA going forward?
You mean income escalation, operating cost escalation?
Yeah, rental escalation.
So the model is still essentially using 4%, which they're linking to inflation and benchmarking in the market. However, given everything that's happened with COVID, we can assume that perhaps in the medium term, some of those model assumptions might change, but for now, nothing's been changed.
Hi, Khomotso. Bilo here. Just a point of clarification, it's perhaps not too limited to the session here today, but in general speaking as well, DFIs usually have a tendency perhaps to, in evaluating the development, to look at the experience of the ODA or SHI. So obviously there's a disadvantage for new SHI, some sort of experience in property development and the industry in general. So I just like to ask quickly, from your experience with existing projects, I've heard solutions last week about ODAs or those SHIs partnering with more experienced organizations in order to make them more favorable to receiving this debt funding. I just want to know the sort of success around those and the typical sort of arrangements around those instances.
Henry, are you still there?
Yes, I'm here. So basically, if you look at your DFIs, I think they are more lenient than your banks. They understand that you might be new in the industry, but in order to mitigate that risk, you want to ensure that you have got a professional team that has got the qualifications, experience, and competent. So that then mitigates that development risk aspect. And most of the SHIs, actually a number of the SHIs are new entities, and the SHRA recognize that. Hence, they would want to ensure that you augment yourself by having a professional team that has also worked this social housing project before.
Okay, thanks.
So, Peter, if you go to a Standard Bank or to a Nedbank and you haven't got the experience, they would say to you, go and partner XYZ and things like that. But here, the SHRA, they understand that most of those SHIs are actually new entrants into the market.
Thanks for the feedback. So, so it's probably more favorable than with the DFIs as opposed to the banks in terms of that sort of arrangement.
Exactly.
All right, thank you.
So Douglas, yeah.
Hi, Douglas.
Remember that IFRS question we had earlier on? Who was the gentleman that you were referring to? Just for some clarity on that question again, please, man, while we got a bit of time.
Joel Naidu, is Joel back?
No.
Okay, maybe Henry, we could text him on the chat privately so that when he comes back, he can assist us on that one.
Okay.
Okay, thanks, man.
Khomotso.
Hi, Puti.
I just want to go back to Mohammed's question, speaking about the minimum of shareholders. Okay, there I understand that you said the minimum of 3 to a maximum of 50, but in terms of directors in the company, what is the minimum there?
It would be, so essentially, it would be the same as what is specified under the Companies Act.
Okay.
I just can't remember those conditions, those sections of the Companies Act off the top of my head. But an ODA is a PTY limited,
Yes.
governed purely under the regulations of the Companies Act.
Okay, thanks. Then I'll just revisit those documents.
So shall we move on to the meat of the presentation? Can we maybe just get a show of hands just to ensure that most of the group is still here? Just give us a show of hands. Thank you, Dolly. Sean, thank you. Manda, thank you. Tavi, thank you.
Hi, sorry, Khomotso. Did you answer? I sent a question earlier on. I'm not sure if you answered it. I didn't hear the response.
Can you maybe just repeat the question?
No, so I want to find out if an SHI, a break SHI that hasn't done any work before, can we do a JV with an existing SHI that has done some work and that is some form of, you know, some reputation of some sort, or an OED or an ODA? Can you do a JV on a project?
Yes, so I think Henry did answer some of that to say that, one, from Schwar's perspective, they do understand and are slightly more lenient around the, call it, track record requirements that the normal traditional banks would require. However, there's nothing stopping you from partnering up with a bigger developer. It would just be a case of the corporate entity, how you incorporate your JV. Are you going to use a PTY? How are you going to structure your shareholdings? But that, you know, there's nothing prohibiting that in terms of your application submission. But I think the point Henry was making was that you will have less of a pushback, or you'll have a less of a push for that from the DFIs and perhaps specifically from Schwa, as compared to what the traditional banks would want, where they would want to see that kind of JV to give credence to the track record.
Okay, no, great stuff, thanks.
Yeah.
So the short answer is yes, we can.
Yes, you should be able to. I think the important thing to raise in terms of with your transaction coordinator would be the incorporation entity. So would they allow you to do it purely as a JV, or would they require that you actually incorporate it as a PTY limited with shareholders, which is what I would think they would steer you towards.
And now, wouldn't you do that as a, you know, like an SPV, you know, just something that is specific for that project? You know, which I suppose would be a PTY LTD, but it's an SPV for that specific project. You know, just for you to get that, to get your feet on the ground, and then as you get the experience and so on, you sort of like take yourself out. You know, so it's just a way of circumventing the process or working around.
Exactly. So that's what I was alluding to. That you would need to find a way to incorporate, even if it is an SPV dedicated for that project. However, then one of the requirements in the application process is the pipeline. So you'd have to have that discussion with them that to justify the pipeline for that SPV? Is it linked to you as the developer, or is it linked to you both and the bigger developer, i.e. your JV partner? That is where you might have a few challenges, but I don't see that that would be an issue.
Okay, great stuff. Thanks.
Okay, I'm going to move on, Henry.
Yeah.
So navigating the QuickScan C. We had an earlier question around what documents are required as a starting point in preparing for the QuickScan C. The 6 main categories: ownership structure. And I think from all the questions, we've seen that this has been coming up a lot as to, you must be clear on, are you applying as an other delivery agent, which implies the 20% equity? Are you applying as an SHI, which specifically might imply that you don't necessarily need equity, but you also need to ensure that you do get your income tax exemption so that you qualify for the exemption from paying annual income tax. And I think we've just realized also now through the comments that the type of incorporation, are you going to be doing a JV? Is it going to be a PTY limited? So all of that information needs to be available, one, to populate the QuickScan C, but also so that you can discuss it with your transaction coordinator. You need to have a QS feasibility costing. So I will just reiterate that it's not necessarily a bill of quantities. It's the feasibility costing that is developed by the QS, which specifies land costs, construction costs, professional fees, sundry costs. You need to have indicative debt terms. That can be either through a term sheet or it can be through a letter of intent. But the items that are required there is the quantum of debt, the term, i.e. the repayment term, 5 years, 10 years, 15 years, the interest rate spread, and benchmark. I would argue, just to note there, that the QuickScan C uses prime. It doesn't use JIBOR, which other financial institutions use as a benchmark lending rate. This model uses prime, and it's a fair assumption because for the most part, the debt that is raised in the call it mid-tier market would be prime related, prime linked. And then arranging fees, that's the fee that the bank charges in order to arrange the structure, the transaction. Your income sources, we've talked a bit about this, how you're going to allocate your income between your residential units. Are you going to have parking rental? Are you going to have commercial income? Your basic unit layouts, so this would be developed with your architect. Ideally, you should be at SDP stage, not necessarily an approved SDP, but a fairly detailed floor plan showing how your units are designed between studios, 1 beds, 2 beds, and how you're going to allocate those between the 5 income bands. And then one that we find often isn't ready when applicants are looking to submit is the long-term maintenance plan. But it is very important, it is a requirement, and you'll see now that it does actually inform a material part of the QuickScan C when we populate our operating costs. When you first launch the model, you'll see that it's a bit daunting, but there are 4 tabs that we really need to think about as applicants. The overview tab, this is the instruction manual. It tells you in that tab that we only work in the CapEx inputs tab and the general inputs tab. And you'll see it's color coded. So CapEx inputs and general inputs are green, which tells us that this is where we would be required to populate items. And then the blue tabs, we don't necessarily need to populate anything unless you are working with your transaction coordinator at SHRA to change some of the assumptions as per some of the questions that have come up. Then it also specifies that you only populate anything that has a yellow background. So going back a bit, we only work in CapEx inputs and general inputs. And in those 2 tabs, we only input stuff in where there's a yellow background. Anything that's in blue coded text is to be adjusted by SHRA, not the applicant, unless you have obtained permission. And we have talked a bit about the fact that the model is a 20-year projection horizon. Unfortunately, it doesn't allow for phased developments. And the guidance is that should you wish to model a phased development, you should contact the SHRA for that. Under CapEx inputs, this is where we enter everything from the feasibility cost. The project costs, land costs, professional fees, contingency, escalations. This is all inputted in this tab, and you'll see that it's a cash flow profile in monthly intervals. So it matches how you will draw down as you're building your project. It also has allocations for income expenses and expenses incurred while you're building. So an example of that would be if you are converting an existing building and you still perhaps have retail on the ground floor, which you plan to keep in operation during construction, you would populate that income there, and any ancillary expenses that you would incur due to that during construction. The meat of where we work is in the general inputs tab. You'll see it split into 4 sections: the project information, equity and financing, revenue information, and operating costs. So in that tab, we basically insert everything about our project, and you'll see now a good example of that. And then the summary tab. This is our risk analysis tab. It allows us to look at everything we've populated, and it gives you a summary of the sources and uses of capital, i.e. where we got the capital. Was it through grants? Was it through equity? Was it through debt? Was it through donations? The uses, how we spent that capital, which is effectively everything that we input in our CapEx input tab. And then it also outlines the key parameters. And I'll recap those parameters: minimum of 30% to primary beneficiaries, minimum debt service cover ratio of 1.3, minimum maintenance reserve provision of 1.02% of development costs, and your residential operating costs must be minimum of 1,350, but in the model 1,300 per unit per month. What we've done here is, through having done the quick scan C a number of times and tried different ways to do it, we found that an intuitive way to populate the quick scan C based on the information you have is to follow a sequence like this. And this is not to say that this is the only way to do it. Some people do it very differently. However, if you're tackling this model for the first time, we think this is an intuitive way to start. Start off with, in your general inputs tab, thinking about the project information. What's the name of your project? What's the name of your company? How are you applying? Are you applying as an ODA or an SHI? Are you tax exempt? Are you going to pay, which means, are you going to pay income tax or not? Where is your project? What is the land size? How many stories are you building? What type of development is it? Is it a new greenfields development, as Henry outlined yesterday, or is it a brownfields refurbishment? Then you follow the sequence of the general inputs tab, which is, it moves from project information to financing. Under financing, you've got a section to put all the details of equity. How did you raise your equity? Was it ordinary equities from investors, or was it through shareholder loans? And you'll see that the shareholder loans function effectively would represent the mezzanine that we've talked about. Then you'll move down to the debt section. The model allows you to input 3 sources of senior debt. So if you are raising debt from different funders, the model will allow you to input debt from 3 different funders, and it also allows you to input all the details of that debt. Then you would move into the revenue, whereby you would need your site development plan, and you'd also need your revenue allocation as to how you're going to split the income between the different income bands. Then you'd move to your operating costs, input in your direct operating costs and your overheads. So all these steps 1 to 4 is in the CapEx input, in the general inputs tab. Then you move to step 5, whereby you're inputting your capital expenditure, land costs, construction costs. That's in the CapEx inputs tab. And then automatically the module will populate the summary tab, which is step 6. So we then move to the summary tab to check our sources and uses that they're correct. And something to think about there is also to making sure that if you're an ODA, you must ensure that at least 20% of your development cost is in the form of equity, whether it be normal equity or mezzanine. And then in that summary tab, we've also got all the requirements for the key 5 parameters that we must check that they're satisfied. Some terminology that we will come across in the model, the rent quote. All the rent quote is the maximum percentage of household income that can be spent on rental. Globally, the market guidance is that for affordable housing, the rent quotes should be somewhere between 25 and 35%. You'll see that the QuickScan C allows you to do a spread whereby for your lower household incomes bands 1 and 2, it sits between 20 and 28%. And then for your secondary beneficiaries, it ranges from 30 to 37%. But the average between income band 1, 2, 3, 4, and 5 cannot exceed 33%. So on average, everyone in your building, on average, cannot be spending more than 33% of their household income on rental. It might be that people in income bands 5 are spending 37% of their income, whereas people in income bands 1 are only spending 25%, but the average cannot exceed 33%. And you'll see when you get the template that that number sits at about 32.4%. Then there's the short-term grant retention facility. This is something that often gets ignored, but becomes an issue at either CP stage of the CCG or at FC stage of the CCG. So i.e. now you're really preparing to hit the ground. Everything's ready, plans approved. You want to now finalize your approvals with the bank and sign your loan agreements. And then this issue of the grant retention comes up. What it is that under the consolidated capital grant, one of the provisions is that for every drawdown you make, the SHRA will hold back 10% of each drawdown. And that accumulated 10% is only paid to you as the developer upon one completion of the project occupancy certificate, and then also in milestones leading up to the 100% occupancy of the building. And you can have discussions with the SHRA as to whether you pay a portion at 50% lease occupancy and then another portion at 90%, but you cannot get all of that grant retention before you fully let the building. But I will specify that that lease-up period that they require is 3 months, but you can negotiate with them that perhaps after 1 month, if you've hit 50% milestone, then 50% of your retained grant can be paid out. And then likewise, as you in months 2 and leading up to 100%. But the standard requirement is that you need to fully lease your building before you can claim 100% of that retained 10%. So what the practical workaround is that there's 2 options. You can either enter into a construction contract, whereby instead of the contractor giving you a guarantee, you enter into a retention structure. But that can also have its pitfalls, because typically the contract would be that you can have retention up to a maximum of 5%. And then your problem is, once you finish and the contractor has practical completion, he's expecting you to pay 100% of his retention. But the SHRA is only going to pay you your retained 10% upon meeting the lease-up milestones. So it still leaves you exposed. So the most practical solution is that you need to have a funding facility with another funder, whether it be the same senior funder that you're borrowing from, so that they fund you that gap shortfall. So for every drawdown from the CCG that, let's say use an example, your drawdown was R1 million. The SHRA is only going to pay you 900,000. There'll be 100,000 Rand held back. Your funder would then plug that gap throughout the construction program leading up to completion. So therefore, your contractor would not have a cash flow mismatch. You've managed that risk. And then obviously when the SHRA repays you that full grant retention, you would use that to repay your funder. And it's important to input that in the QSC because it does create a debt service cash flow impact. So I think, you know, in today's world where rates are quite low, that shouldn't be too much of an impact, but it can become an impact, you know, in normalized interest rates and also on very big projects where there's no equity and it's fully geared. Swap costs. So we won't spend too much time on those. Those really relate to if you were hedging your facility. But as Henry mentioned yesterday, that's typically for very, very large facilities. And likewise, the tax wear and tear really relates to the income tax calculations. Can I just get a show of hands that everybody's still with me? Thank you, Claudette. Thank you, thank you. Valente, thank you. Okay. Thank you, Kate. So what we've done is, you know, obviously we are also adjusting our format for presenting the project packaging. And, you know, if we were in a physical format, we would have typically done a case study where we would have given everybody the opportunity to actually physically populate a case study QSC with us in the room, and we all work through it together so that everybody can get an experience of what it's like to populate the model. But in the absence of that, we think a practical solution is short videos showing you us working through a quick scan C and populating it. Some of them are about 3 minutes, some of them are about 1 minute. So I'd ask you just to bear with me because I think it's quite informative and you actually get to see what this model looks like. You get to see how you would source information and where you would populate.
I just have one question. Sorry.
Claudette?
You know, we've got the email that went out had the training manual for QuickScan B. I don't see a training manual for QuickScan C. Is that available? And can that be circulated like something you presented today, just so that we have that information on hand? Are you able to send it through to us?
Certainly, the presentation that we presented today will be circulated. Henry, you can correct me whether the actual QuickScan C2 was sent out.
They come in there, Khomotso.
Thank you, John.
Yeah. So what we released was the tool itself and the manual, which is quite brief. Remember that thin version that we had prepared and had used largely in last year's. I'm not sure. Claudette's question might more relate to, if you look at QuickScan C, the tool itself has also a guide that goes with it. I don't think we have that except the manual that between ourselves and yourselves, Henry, we had prepared as a guide that helps people to maneuver and how to use the Chris tool.
John?
Henry?
Basically, I think the videos that Komotso is going to be playing is going to assist in how to populate QuickScan C.
So that is the essence of that manual then?
Yes. Yeah.
Okay.
And
Thank you.
Hope that helps.
Thank you, John. Thank you, Henry. So let's start off with, this is essentially a video of a case study that is being populated. And let's just make sure the audio is there. You can see that it's developing 100 units, construction period 13 months, pre-tender and contract periods 2 and 11. And the first tab. This is the instruction page, as John was mentioning. It includes all the details around the model. And it gives you a guide on how to navigate the model, and it also specifies the documents that are required and likewise what you can and can't populate. You see that we only work in 2 tabs, CapEx inputs and general inputs. This is the CapEx inputs tab, which is a monthly forecast period. And you can see there that you'd only input data in the cells that are yellow. General inputs tab, structured by project information. Financing information, which is the equity and the debt. You can see at the top it's got equity contribution amounts, then shareholders loan, and the 3 senior debts. Then there's a section for filling in your VAT information. Then the section for revenue allocation and revenue splits. And then your operating costs and your overheads. It'll transition quickly now just to recap the details of this project, and then you'll see them filling it in. 5 stories, 5,000 square meter stand, developing 100 units, 13-month construction period. Number of stories, land size. Remember that it's in hectares, so 1 hectare equals 10,000 square meters. The applicant name. Is it an existing SHI? If you're applying as ODA, you'd say no. Is it registered as a VAT vendor? Okay. So just to go through what that video did, we're working in the general inputs tab. And if we go back to how we suggested we tackle this model, the first stage is project information. So you saw there that we inputted the project name, the commencement date, construction period. Then we moved to the location of the project, the type of project, is it a new project or refurbishment, number of stories, the earth size in hectares. Then you input your applicant name. Is it an existing SHI? And if you're applying as an ODA, then you would say no. And whether it's a public benefit organization, and also whether it's a registered VAT vendor. And you'd also have to input here whether it's whether corporate tax is payable or not. Now, the cost of land, you'll see that you can't actually, it's not in a yellow background. So what happens is that number would automatically get populated once you get to step 5, which is your CapEx inputs tab, which is where you populate the land cost, including any conveyancing fees. Do we have any questions on that from the room?
Quick question, Khumalo.
What's it?
What are the implications of not being VAT registered?
So we will get that into, you'll see there's a whole VAT section, but the important consideration is that VAT is a consumption tax, which is essentially added on to, which is eventually billed every time you add value to a product. So you have 3 types of products: VATable products, non-VATable, and VATable at a 0 rate. Unfortunately for us, the business of residential rental is not VATable. So we don't, when we invoice our tenants, we don't charge them VAT. So the production of income in our business is a non-VATable supply. Therefore, we cannot claim VAT against the production of our income. So effectively what that means is, even though when we produce a feasibility costing and subsequently a BOQ, that will include VAT because the suppliers who we work with, the contractor, the engineers, everybody charges VAT if they are VAT registered. That cost to us as the ODA or the SHI is not a cost that we can claim back. So the implications are that if you're not VAT registered, it's a moot point because you wouldn't be able to claim the VAT anyway. However, if you do have a mixed use facility, you are able to claim VAT on the commercial elements of your development. But then obviously then you'd have to be VAT registered.
Okay. So when I put on an invoice for the grant and I'm not VAT registered, how is it going to go there? Because now when I go pay my suppliers, I need to pay them with VAT if they are VAT registered.
Yes. So for example, let's say your project development cost, excluding VAT, is 100 million. The model automatically adjusts for the fact that your CapEx cost has VAT on that. So your total CapEx cost would be 115 million. And that's what the grant would be funding. It funds the VAT inclusive value.
Oh, okay. All right.
So the only difference is it's not an in and out like it would be with a commercial development, where because we're paying VAT on our construction contract, we can go and claim that from SARS. We can't claim that cost. It's a sunk cost effectively because our rental doesn't charge that.
Okay. I'm answered, thanks.
Okay. Henry, are there any other questions on this step 1? Okay, so going back to our framework, we said step 1, project information. I think we showed exactly where you'd fill out all that information. Step 2, we move to financing, thinking about how is the capital raise, either through equity or through debt. So in our case study here, we've used a funding structure where there's equity and debt. And this shows you how we populate. Data would come from your temp sheet or your letter of intent. You can see they were putting in a 10-year loan facility. Putting in the spread. Important to note that you can distinguish between the prime spread during and post-construction, but typically that would be the same. Then the interest grace period, very important. That's the period before you need to start servicing interest and principal. Typically, you want to align that to your construction period plus 3 months. So effectively the lease-up period that SHRA would specify in your CCG. So you can leave those cells empty if you only have one source of funding. Is that helping with the sound? And then the short-term grant retention facility, that's where we were talking about that plug facility to help you with that shortfall. The equity, once again, we need to think about how is that equity raised. If it was raised as MES 100%, then we'd fill out the 100% shareholder loans. So what it'll do is it'll convert the full 6.9 million into MES. And you can see that prohibition on repayment of equity. So that is the period before you have to start servicing your equity. So that really gives you, I think, an intuitive example of how the financing section is populated. The top part is equity contribution. And in the bottom here is how is that split? Is it pure equity or is it shareholder loans? And by shareholders loans, we're referring to typically the mezzanine. Or if you do have a shareholder who's provided you with a loan, the underwriting and arranging fees, and then the prohibition on repayment. So that's the period until you need to start servicing your equity. Your equity hurdle rate, that's an internal metric where you as a business with your investors would determine what is our target return on the equity that we're raising. Is it going to be 12%? Is it going to be 13%? Is it 15%? And typically, you know, you'd benchmark it to other investments in the market. For example, if the stock market is giving you 13%, you'd expect that the equity return you require for investing in an asset which is illiquid and fixed would be slightly higher than that. So it might be around 15, 18%, but that's an internal business decision. Then an important point to note is the shareholder loans. These are only serviced from cash flows available after the payment of debt. So it's operating income, less your debt service, which would be your senior debt facilities. Then whatever's left over is what you can use to service these shareholder loans, i.e. mezzanine. And then your key debt inputs, the term of the loan, 15 years, 10 years. What we have found is for SHIs, typically where there's that tension between the project costs. Let's say the project cost is above 400,000, maybe it's sitting at around 430, and the SHI wants to structure it such that they don't put any equity in, then you are going to have to consider debt terms that are longer than 10 years, typically around 15 years. Otherwise, you won't satisfy that debt service cover ratio of 1.3%. And even for the debt facility, you'd have put in the arranging fees, typically between 1 to 2% of the loan amount. The commitment fees are just fees charged by the bank on undrawn amounts of your loan facility. Not all term sheets would include this. So you just have to check that quite carefully. Do we have any questions on that section?
There's a question from Joel Knight, who is back.
Oh, great. How are you, Joel?
I don't know if he's...
Yeah, he's responding. Joel, perhaps could we ask for your input? There was a question around the accounting treatment of the grant. You know, so we'd mentioned that if it has no obligations, intuitively it would be equity, but you corrected us to say that the correct IFRS treatment is that it's treated as a liability. Perhaps you could expand on that a little bit. Okay, I'll give him a chance, Henry, and I'll move on to the next page.
Okay.
Can I just ask a question?
Correct.
Okay, so around the equity and the debt, so if your land is forming part of what the SHI is bringing through, on the equity tab, there'll be no input there because your land would form part of that 20% that's coming from the business. Am I right?
So you would populate that value as your, because remember, there's the sources of capital and the uses of capital. So
yeah,
you are correct that the uses of capital would be land and development costs, but how you fund that total development cost relates to the sources of capital. So effectively, if your land was 10 million in your development cost, under the equity tab, because it's a source of capital, we would put 10 million as equity, but we wouldn't populate any other variables. None of it would be shareholder loans. There would be no underwriting fees. There would be no hurdle rate because you already owned it and it's already in the business.
Okay, thanks. That's the first thing. The second thing is under the debt. When we talk about the long-term debt, we're talking about the loans from the banks, and then it'll be the typical NHFC loans. Am I right?
Correct.
Okay, thanks.
Okay. Joel, are you with us, Joel? Okay.
Hello.
Hello.
Just going back to what has just been asked, what if that land was bought through a loan?
So the land can only be equity if it's unencumbered. So if it's got a loan on it, effectively that means it's encumbered and you cannot recognize it as equity.
Okay. Thank you.
Sorry, Komoto.
Mm-hmm.
If I may come in, let's say the land is worth 10 million, right? And you have done an independent valuation and says this land is 10 million and you still owe 8 million. You still owe 2 million. So the 8 million becomes part of your equity contribution because you still have to repay that debt.
Okay. So this is just some of the information that we talked about when Puti raised the question around VAT. So just to recap, 3 types of VAT. vatable supplies, non-vatable supplies, vatable supplies at a 0 rate. Residential rental is not vatable, therefore we can't claim VAT on it. However, commercial rentals are vatable. So to the extent that some of your capital cost relates to commercial elements of the building, you can claim VAT on that proportion. Easy example, if our total development cost was 100 million, 30% of it was commercial. Of that 100 million, we could claim VAT on the 30 million because it relates to commercial. But just remember that SHWA will not give you a grant for the commercial elements. So effectively, whatever relates to the grant, you cannot claim VAT on it, even though the grant funds the VAT cost, because all your service providers, your vendors, the professional fees, the contractors, they will typically charge VAT. So moving on to, let's just recap our sections. Step 3. So we've now put in our project information. We've put in how we're going to fund the project, sources of income. Now, sources of capital. Now we're moving on to the revenue. So this is where we'd be using the HDP to populate how we're going to split the units between the different income bands. So reduce the sound. So this is an example, 100 units split between the different income bands. So as you move through the financing section, you just come here to check that all your VAT items are correct. Are you VAT registered? And if you are you claiming VAT on commercial elements? You can see there, that's where you set out your different revenues. The first row is, I see there, sometimes that model jumps around. The first row is the size of units. You can see it's 30 square meters, 32, 35, 40, 45. That's the size of the units in square meters. Now he's going to input 1 bed, 1 bath, 35 squares. Should be 40 and 45. Okay. Then you input the number of units. So effectively, the first 3 rows is for primary beneficiaries. The bottom 3 rows is for secondary beneficiaries. And for each section, there's a first row for size of units. And if everything is working, you'll see in the far right-hand side, there's a check, and it must be all green. That means that you've met the SHWA requirements of income spread between the different income bands. Then at the bottom there, you can see the forecasted vacancy rate, which you have to adjust based on your assumptions, and the rent quote. As we discussed, the rent quote ranges, but on average, it can't be more than 33%. Henry, I'm just going to close my chat so that I can see my screen to talk through these slides. Please let me know if questions come up. So in populating our income bands, first step, having the SDP in front of us so we can populate, remembering 30% must be primary beneficiary units and 70% must be secondary. The way that the bands are set out, and these are typically published either through a letter from SHWA, and you can contact your coordinator for that. They are intermittently updated. However, typically it's not too often that they get updated. What this shows is band number 1, upper income, 3,500 household income, lower band, lower threshold, 1,500. The rent quote as a standard 25%. And what that then shows you is your maximum rental and your minimum rental. You see that if you keep the rent quote as per the standard in the model, it's going to give you the average between the minimum and the maximum. You are allowed to adjust those numbers by adjusting your rent quotes. However, it's also important that in doing that, you consult with the SHWA so they know exactly what the changes you've made in the model are. Then the way that the requirements are that you are required to have at least 10% of your total unit allocation in this income band. So the first income band of primary beneficiary units. Then the second income band, households earning between 3,500 and 5,500. And that means that implies a minimum rent of 945 to a maximum rent of 1,485 per unit. And you'll see that if you keep that rent quote at 27%, it implies an average rent as populated there of 1,215. Then we get to income band 3, households earning between 5,500 and 7,700. And that implies minimum and maximum rent as populated there, 1,700 and 2,400. Once again, keeping the rent quote constant gives you that average rental of 2,100. So you can see how the requirements are set out. This is also a standard that is populated into the overview tab of the QSC. So if you were to change anything, you can change some of those assumptions, but with the discussion of the SHWA. And in your actual model, what happens is as you input the units, remember we said there's 2 sections. Section A, primary target market. Section B, secondary target market. For each section, there will be a top row, which is the size of the units. Likewise over here, that's the size of the units. And then the next 2 rows, next 2 rows at the top and the next 3 rows at the bottom would be for the number of units. So in this example, it means that there are 31 studios. There are 10 studios of 31 square meters. And then there are 20 one-bedroom apartments of 33 square meters. And those 1 beds are allocated to income band 2. And you can see it means it's satisfied the 20%, correct? And those 10 units of studios are allocated to income band 1. You can see it's correct. So we've satisfied that 30% split between 10 and 20. Then we come to secondary target market. First top row is the size of the units. Then the next row is allocation of number of units to income bands. So here we have 20 one-bed units of 40 squares allocated to income band 3. Then we have 20 one-bed units of 40 squares in income band 4. And we have 30 one-bed units of 45 squares allocated to income band 5. So it can be quite a complicated process in terms of allocating the units, but the main thing to use as your guide is this check over here, which will tell you when you have allocated something incorrectly. And often what we see is we forget to populate the size of units at the top here. So that's quite important to remember. So just a practical, okay.
Can I ask a question?
Yes.
Is there any link between the income band check and the weighted average rental quote? So what I'm asking is that if you're in the red with the income band check, but your weighted average rental quote is still sitting at like 32%, is that an issue?
Yes, so if you're in the red with the check, that's more of an issue of, just a sec, that's more of an issue of allocation between the income bands and satisfying the income spread. So 10% of units in band 1, 10% in band 2, and likewise 20, 20, and 30. The rent quote is more around the rentals. So when you change your rent quotes, your average rentals move around. So it's more about the affordability.
Okay, so if the income band check is in the red, is that's obviously an issue then, hey, because it must meet with that 30% and 70% for the secondary, am I right?
Correct. Correct. So we cannot
Okay.
move forward unless everything is green on the income band check.
Okay, thank you.
Khomato?
Kuti?
Question here. I just want to a clarity here. You see where it says a bachelor flight studio, then underneath it there's type 1, type 2, type 3. Is there a legend that explains what type 1, type 2, type 3 means?
So you would, that's for you to develop. So
Okay.
your submission, you would have a write-up, and also which links to your SDP or floor plan, which specifies what your type 1 is, what your type 2 is, what your type 3 is.
Okay.
So it's just, it's just a template, but you would have to then give more detail on how you split up your units.
All right, thanks.
Okay. So this is really continuing on that example. Requirement must be 30, 70, but then it's also important that in the secondary beneficiaries, you need to hit the threshold of 20 for band 3, 20 for band 4, and then obviously the residual would be what's left over for band 5. And like we're answering that one question, the income spread is more around how you satisfy the income check, the income band check, but the rent quote is more around the rentals. So this is really just unpacking what happened in that model. That first row was the size of the unit. The second row is the number of units. And then you can see that we have 30 primary beneficiary units, studios at 15, one beds at 15. You can see that there, the one is 31, the studios are 31 squares and the one beds are 33 squares. Then likewise, we had 70 secondary beneficiary units allocated as 20, 20, and 30. So it's always important to remember that for each section, that first row is the size, and that's the size. And then the rows after that is number of units. So going back to some of the stuff we have discussed, the rent quote affects the rental. It affects those numbers. So as you change those numbers will change.
Khomato?
Hi, Cass.
Yeah, just a quick question. There was a presentation that I attended at some point, and then there was a lady from Shira who said that they don't build studios, or they do not support the building of studios. Are you able to give some guidance on that?
That would be, I think we'd have to maybe throw that also over to Shra as a follow-up question on the session. However, in our process, we've actually submitted projects which have been approved, which have studios, but as long as the studios are 1, self-contained, and 2, a minimum of 30 square meters. So what self-contained means is it must have its own kitchen and its own bathroom. Then, we've actually had projects which have been approved on that basis.
Okay, thanks.
Anything further before I continue? And maybe just the last one is just remember to always check that the vacancy assumption is correct. The model comes standard with 7%, but as mentioned earlier, you are allowed to motivate with your coordinator if you think that your entity will achieve a lower vacancy. So now we move let's go back just to recap our process. To step 4, direct operating costs. Direct and overhead. So we've really talked about what these are, and you'll see how we populate these. So ideally, if you're doing this, you'd want to develop a schedule of operating costs beforehand, before you come to the quick scan C, so that you can then just take all those costs and populate them into the quick scan C. You'll see here that we're just checking that we said we have no other sources of income, so we're just cleaning that up. We don't have shared ablutions, we have no parking that's charged for. And then you take all your direct operating costs from another spreadsheet, build it up, and then populate it into here. The most important thing is all these costs are annual costs. And typically when we forecast, sometimes we forecast monthly. So make sure that you're converting your numbers into annual numbers before you populate. And then your provision for bad debts, all you have to do is you insert the percentage there, and then it will automatically update that. Minimum of 2%, and then you would insert your rates and taxes, and likewise the rest of your costs. This is where you would need your maintenance plan, because what you would then do is you would take your average maintenance for preventative and reactive, and you'd use it to populate those line items. Equipment, electrical, plumbing, paints, gardens, lifts. And typically you'd work with your property manager or facilities manager if you have one, and an architect to populate these. Your security costs, and then the big one that the model doesn't specifically specify, property management fee. And we see a lot of participants who forget to put that in there because it's not a line item. And then your annual costs, these are your annual overhead costs, reports, audit fees, bank charges, UIF for salaries, and your forecast utilities. It's very important here, don't duplicate with the common area charges that are required, that are line item under direct operating costs. And then you also specify what the utility cost recovery rate is. So is it going to be 100%? Is it going to be 70%, 80%? And it's quite important to be careful with that, because essentially, as we mentioned earlier, remember with recovery, we typically in residential rental would only recover water and electricity. Sometimes you're recovering refuse and sewage, but not as a rule of thumb. So that little box over there, it's quite important to think through it. And then the next item also is think through that you should not duplicate what you're inserting in this section here with the common area charges that are inserted under direct operating costs. So this is really just reiterating what we've talked about, the distinction between direct operating costs and overheads. And as you saw in that video, everything is in annual. Hello, is everybody still there? Henry, am I still here?
Khomotso, are you back? Just saw
you guys, but you couldn't see me.
Sorry,
Yeah.
I think we'd lost you for a bit there.
Okay.
Yeah.
Sorry, I could see you, but I think you guys couldn't see me.
Oh, okay. All right. Good to have you back. I am not sure. I think we probably just want to go back a slide or two or where you're currently sitting, you might just want to go back a line or two.
Okay.
So I think that's when we lost you. So it's not long.
Okay. So we were in this section. Can everybody see my screen?
Not yet. Yeah.
Okay. So as you can see there after the video, we're populating direct and operating costs and overheads. And the key thing to remember is the numbers you insert here are annual costs. So always convert from your monthly costs and get them annualized. Remember to put in your provision for bad debts. Minimum is 2%, but the model will typically come with a provision of 3.5%. And the one item that we often see left out is the property management fee, which is a direct operating cost. So you would effectively have to calculate that. Easy example would be taking your gross rentals, multiplying them by the property management fee, call it 5%, and you take that number, the annual number, and populate it in this section over here. Then overheads. Similarly, ideally, you should populate them in another spreadsheet so that you have an itemization of everything. And you would then also remember, always convert them to annual values. And I mentioned the importance of not duplicating water and electricity in common areas with your utility assumptions. So that gives you an example that if you put in a provision for common area water and electricity, you should also think through how you populate your utility assumptions in the following sections. Are we all still together on that? Step 4. Henry?
We are getting a heads up, Komoto. So I'm assuming everybody's on board.
We are on board.
Okay.
Komoto?
Would you?
Just one question. I see there is an allowance for operating costs like cleaning. In my mind, I'm thinking of land service, landscaping service costs. Are those allowed, or it's just me? It's just us as the ODAs playing a trick of saving costs.
So when you say landscaping, are you talking during construction or after construction?
No, after or during operations of the. During the operations of the asset.
Agreed. So
the development.
Those would be your prerogative business to decide on, well, to itemize the running costs. And if landscaping is included in gardening, then certainly include that.
Oh, okay. So now we are only on the phase of pre-construction and during construction.
No. So step 4. I'm just going to go back a little bit. Step 4 is step 1 is normal project information. Financial information is pre-construction because it's how you raise your capital. Revenue relates to after construction once you are operating.
Okay.
Operating costs. Step 4, after construction, once you are operating. Step 5 is pre-construction because it's all your capital expenditure. And you'll see in the step 5 tab that there is a provision for income and expenses during construction. So that's a separate item.
Okay.
The model does allow for that.
All right, thanks.
Okay, we've done this video. So we can move on to step 5, capital expenditure, everything that we get from the QS feasibility costing. I'll reduce the volume. So this is an example of a feasibility costing. It's got sections: land costs, construction costs, civil services, preliminaries and generals, escalation, contingency, professional fees, and then it's got the total capital requirement. So you'll see here the model is in monthly projection periods. And what you'd fill out there would be your land costs and conveyancing costs. And then you'd populate.
Sorry.
Okay.
Before you go on to that, under grants other, so we're still on the general inputs, forecast utility costs. Underneath that,
Just let me get to the section that you're talking about. So financing.
it's right at the bottom, grants other. There's also some, it's also highlighted in yellow where we can input some information there. So it's on general inputs, line 230.
Right. I will change my share screen so we can see what she's referring to. Can everybody see the quick scan C?
Yes.
General inputs. So obviously the additional provisional contribution or grant funding is, it's picking up from somewhere else, from information that we've already inputted into the model. The additional grants or donations, we need to put that in as well again.
So that is, and I think at the end of the session, John will touch a little bit on that, on what those additional grants are. But that would be, remember we said that if you did have donations as another capital source, aside from your restructuring capital grants and aside from your provincial subsidy, then you would input it there. And the staff gear up grant, I think John will touch on that. If he doesn't, we can ask that the SHWA give a bit more clarity on that, but those would be above and beyond the normal standard consolidated capital grants.
Okay. Okay, thank you.
That's just showing you what it looks like and set out in monthly intervals as mentioned earlier. And that's populating in the forecast period, total construction costs, professional fees, plan approval fees. And you can see at the bottom there's a space for revenue during construction and overhead costs during construction. So
Khomotso, these are all monthly costs, right?
Yes, yes. And perhaps a good point to note here is that this would align with your planned drawdown schedule, how you plan to draw down on your project. And then also remember that there will be 10% of each of those drawdowns held back as a grant.
Can I also just add something? I think everyone must just be careful when we're inputting our figures. Under the general inputs, hello? Hello?
Yes, we can go ahead. Go ahead, Claudette.
I said I just think everyone just should be very careful around the general inputs. When we're putting figures in there around the operating costs and stuff like that, those figures include the VAT. But when we look at the CapEx inputs and when we're putting our costings around there and including our annual inflation increases and stuff, those are excluding VAT.
Thank you, Claudette. That's a great point. That's a great point. I think you can see it there. It says in actual prices, including inflation, but excluding VAT. So perhaps that's also a point to raise there, that sometimes what we see is the escalation is included as a separate line item. So it's important to also make sure that you do include it in your CapEx inputs tab, because the model is assuming that one, the numbers you're inputting are already escalated, and if not, you have to insert it as a separate line item for the project period escalation. So once again, the model is monthly, typically between 8 to 12 months. All values should be excluding VAT, like Claudette mentioned, because the model automatically adjusts for that. The top part is the land costs, and you'd also include the conveyancing costs and any commissions that are payable in this section. What we've seen is the SHRA wants to see the commission split out. If there is commission paid on the land, it must be included as a separate line item. Then we'd insert any revenue during construction in this bottom part over here. And this leftmost column is a total of all the monthly inputs to the right-hand side. So everything that's inputted in yellow, the total of all of that is found on this leftmost column over here. So what we found the best way to tackle this is take an extract of this tab in the model and send it to your quantity surveyor to populate, because they would be well positioned to give you a cash flow projection profile and input and populate this quite accurately. And then they can send it back to you, and you can then just cut, copy, paste those values back into your main working QSC model. So remember, we had those 6 steps. Step 1, project information. Step 2, financing information. Step 3, revenue. Step 4, operating costs. Step 5, CapEx. And then step 6 was tying it all together to understand that our sources and uses are correct, and to understand that, check that we've satisfied the key parameters.
Sorry, before you proceed quickly, I'm just looking for confirmation quickly regarding the CapEx. I see we have CapEx here mainly for during construction. Is there some way that we could perhaps factor in CapEx for stuff that you set aside for Kitty for future renovations or upgrades of the property, because that will also be a CapEx cost in terms of going forward?
So the model doesn't specifically provision for that. However, to an extent, you could maybe include it as some of the planned preventative maintenance, but it doesn't specifically include it as a future CapEx line item, unless you just included an extra provision which you want to put aside as a deduction on your income to set aside for future budgeting on CapEx. But maybe if I can just share my screen. Let me do this, then we can go back to the QSC. So you can see that it doesn't really provision for what you're talking about, in terms of, and if I understand correctly, you're talking about CapEx that is funded from equity or debt for future renovations, not CapEx that is funded from gross income. Is that what you mean?
It could actually be from gross income once it's operational, but to your point as well, that was my initial address.
Okay, so from a point of future capital expenditure, the model doesn't provide for that, but to the extent that you did want to have a provision for gross income, which you're putting aside as for remedial capital, you could just insert it as a line item here. And then when you submit a write-up for your QSC, what we've seen is a write-up helps a lot. So effectively it would be a document detailing the assumptions behind every line item, so that when the external assessors review your document, they can understand, how did you get to your cleaning assumption? Are you assuming you're going to have 3 cleaners, 4 cleaners, 5 cleaners? How did you get your insurance assumptions, your rates and taxes, and something like that, where you're saying remedial capital expenditure funded out of income? You could include it here, but as long as you explain it, then the assessor understands what you're doing.
Thanks, got it.
Hi, Khomoto, can I ask a question?
Yes.
In your KPIs, your first line there says it's 30% for primary target market.
Yes.
Does that mean that we could do the 30%, which is 10 below the 3.5 income, and then 20% below the 5.5? And then could we have basically the high end, basically 2 bedrooms for the remaining 70%? Or does it actually have to be broken down the way you guys had it broken down in the spreadsheet?
You do have to break it down in the spreadsheet, in the sense of you have a income spread requirement, which as a template, the SHRA requires it as 10, 20, 20, 20, 30. They typically don't allow us to change that income spread much, and also that's how the QSC is set up. What we do know is definitely the 10 and 20 is completely non-negotiable. Whether you might be able to talk to your coordinator about changing the secondary beneficiaries, you would have to engage them. But as it stands, in our experience, they don't really allow us to change that. But you would have to ask them on that, whether you can change the secondary beneficiaries, but definitely primaries, you can't change that.
Has there been any experience or prior situations where that has been the secondary beneficiaries have been chopped and changed?
So far, to my experience, I haven't come across a project like that. Henry, I don't know if you have in your experience.
No, not at all. Not at all. We've always followed 20-20-30.
Okay, thank you, Jens.
Okay, so I'll just run through this. Can everyone see the video? So now, if we're done here, we just check that everything is in order in our general inputs tab, in our CapEx tab, and we move to our summary. You see that it's got application of funds, uses of funds, and sources of funds. How we raise the money, what we use the money for. And a typical problem is the facility exceeded error, which now, because when you input your senior debt value, you haven't necessarily accounted for the fact that you're going to be building maybe for 15 months, and you're going to have interest accrued on that facility. So if your facility number is too small, it won't adjust for the fact that the model automatically accounts for accrued interest, and you'll typically have to go back and adjust that. You'll see there that it's checking the 30% requirement. It's checking the residential operating costs, minimum 1,300, minimum maintenance of 1.02, it's 1.2 in this instance, minimum project IRR of 14%, and then the last one would have been the minimum debt service cover ratio of 1.3. So just talking through some of that, the sources of funds and the application of funds. Going back here, remember we said in the equity section under financing, you would put in equity, and then you'd be asked to put in what proportion of that equity is shareholder loans. If it was pure equity, you would put 0 as shareholder loans, which means that that 15 million in this example would be all the share capital. However, if you said 50% is shareholder loans, then it would be 7.5 and 7.5. The only thing to remember, if you're an ODA, the sum of share capital and shareholders' loans must be 20% of your development cost. And then like we talk about that in the slide, ODA is required to ensure 20% is project cost, whereas SHI is not necessarily. And then at the bottom here, we're just showing how the application of funds would be. Remember that the total of application of funds must equal the total of sources of funds. What you're raising must be able to fund 100% of what you're employing the capital in. Then the key parameters. So the model automatically uses a tick to show where you've complied and a cross to show where.
Sorry, can I just go back to that on the source of funds? Sorry. So under source of funds on the long-term bank debt, where the facility is exceeded, what's the acceptable percentage there?
So you
or
it's a bit of a back and forth exercise you would have to do, whereby you would have to look at, for example, in this instance, the facility was 1.9, but we had inputted a loan of 1.8. So all we have to do is we have to go back to section 2 under general inputs, increase the loan facility to, it's a back and forth. Let's say you increased it to 2 million. Then what it would do is that drawdown on that loan, it would only be up to the maximum of the actual loan plus the interest accrued. It doesn't mean necessarily that it's going to draw down all the way to 2 million. And I can actually give you a practical example of that.
So are you saying to get out of the red, you adjust the loan facility, the loan amount?
Correct. So,
and that will automatically take it out of the red?
Correct. So let's see here. Can you see my screen?
Yes.
Can you see what happened here? So I went to the loan facility and I said, let's assume our debt was 1.4 million. And automatically it says facility exceeded.
Yeah.
You see that? So I would then do an exercise of a bit of back and forth, and I'd say, well, if my loan facility is 1.5 million, would it cover all my capex and my interest accrued? Still not enough, because everything is 1667, 166. Okay. So I come here and I say 1.7. And it's resolve the matter. So now we have enough of a facility to cover your capex, your interest accrued, and your arranging fees and all the other financing charges on that facility.
But doesn't an increase on the loan affect that debt service cover ratio? Wouldn't it affect that?
It certainly would. So, and that's why
then you'd have to readjust your costs.
No, so you'd have to check that it doesn't throw your debt service cover ratio out of kilter. And then you have to go back. If it does, then you have to go back and look at your rent quotes, how you allocated your incomes. You'd have to go back to your operating costs. But obviously remembering that with operating costs, you still have to meet the minimum of 1,300 per unit per month. And then the last element, effectively you go through that whole system again. Check your revenue, your financing assumptions, see where you can adjust revenue, see where you can adjust operating costs. And then the last step would be to see where you can adjust your capex. But essentially adjusting your capex would mean adjusting your project budget.
Yeah. Okay, thanks.
So it's a bit of a troubleshooting exercise.
Yeah, it is.
Okay. So on the KPIs, number one, minimum 30% primary units. Number two, average monthly residential costs must be above 1,350 as the guidance, but the model does allow you to minimize out at 1,300. And the way to fix that, as I mentioned, would be looking at your direct operating costs and also looking at your capex. So those two things will drive what your residential cost per unit is. And then it's also important to note, if you have a development which is mixed use in the sense of it's got commercial elements, and maybe it's also got elements which are unfunded by the grant. So for example, if you had rooms but those don't relate to your grant, but they do relate to your project costing, your project overheads and your project direct costs. This metric of residential operating costs only looks at capital grant dwelling units. So for your residential operating costs, they must be a minimum of 1,301 as per that model. It doesn't factor in all the other non-grant elements. Then your maintenance provisions must be at least 1.02% of capital costs. We see if it's in compliance, we'll give you a tick. Your project IRR must be a minimum of 14.5, basically determined by 10% plus 4.5. Should in future iterations of the QSC, SHRA change the benchmark of prime to say 8 to 9, then we'd imagine that this IRR would also change proportionately, but as it stands, it's still at 14.5, and the minimum debt service cover ratio of 1.3. The way to adjust, let me go back up a bit. The way to adjust, if you haven't satisfied the maintenance provision, you'd have to look at your maintenance plan. If you're below the 1.02, you'd have to increase your maintenance budget, or you can decrease your total capital cost, because then that will reduce how much you need to spend to get to the 1.02. To adjust the IRR, you pretty much need to look at the whole model. It's everything, your capital costs, your financing assumptions, your rentals, your direct costs. So increasing your rentals would increase your operating income, which increases your cash flows, increases your IRR. Decreasing operating costs also decreases your operating income, which increases your IRR. Getting better terms on your debt in terms of cost of repayment also would increase your IRR, and obviously reducing the cost of the project, but still achieving the same number of units with the same income would also increase the IRR. The debt service cover ratio, likewise, pretty much affects everything. Your rentals, because it's driven by operating income divided by total debt service costs. Your rental assumptions and your operating costs affect the operating income. Your debt service costs are affected by the terms of your debt and the cost of your project. So those are the big highlights in terms of what we have to think about when we're tackling the quick scan C, reasons why it often has challenges and doesn't work, outdated information. So perhaps your QS feasibility costing was done 24 months ago, you need to update that. No debt term sheet, so you have no clear date information on what could be funded, what the terms will be. Would you be able to get 10-year money versus 15-year money? Lack of proof of equity, and the big one, the no bill of quantities elemental estimate, but we should simplify that. It is a feasibility costing, not a BOQ, not a bill of quantities. Does the project doesn't meet key performance indicators? We've gone through that quite in detail. Or if the costs, the capital costs, are just too high. So it's just too expensive. Perhaps you're coming out at 550,000 rands per unit, or your operating costs are just too high and they're too heavy on the project. And that is where we can close it off in terms of content. And I'll open it up to the room to have a quick discussion on questions, if there are any, that we can address now. But I think we can limit that to about 5 minutes so that we can have another 10 minutes just for John and Henry to do a closing.
Hi, Kamoto. Sorry, I just needed to confirm something. So I know Shira works long term and whatever, but let's say we, as an ODA, we give people the rental option, but now they come back to us, they want to buy the unit. Would we be able to sell it after a period of time? How would that work?
So that's a good question, which has come up before. Unfortunately, you know, given that this is more of a quick scan C facility session, we don't have, you know, I can't answer it directly, besides to say that the CCG, so the contract you sign when you enter into the grant, it certainly doesn't have provisions for that. It's purely a long-standing, call it perpetuity agreement between you and the SHRA, where you are in the business of renting those units. In terms of ownership and future sale, I know that that has been something that has come up in other sessions, but perhaps we can table that as post-session questions and ask that the SHRA give us some feedback on that.
Okay, fantastic, thank you. So we work on the assumption that it is like rental only. All right, thank you.
I just can't see, is it?
Pretty here.
Pretty?
Quick one. Just as a developer, do I need to be registered with NHRPRC?
So you don't necessarily need to be registered with NHBRC unless you are a developer contractor. So your contractor, whoever you have that certificate. But as it stands, no, developers not necessarily, but the developer is responsible for registering the units with NHBRC, whether you get your contractor to do that. So if it's a greenfield and you're going to be doing foundations and formwork, then you need to have the NHBRC registration, and the developer must make sure that gets done for every single unit. But typically the contractor would do that for you.
All right, no problem.
Hamata, are you going to be able to share the spreadsheet?
The quick scan C.
Yes.
Yes, and Tabi, that apologies if it wasn't sent out. That is one of the tools. So I'm pretty sure what we'll do is we'll send up a follow-up of the tool.
Okay, thank you.
Can I suggest, because I don't want to do another mail shot, a generic one. If you have not received any of the handouts that including the 2 tools that we have been focusing on for the last 2 days, just drop me mail directly in my email, johnm@shra.org.za, because there was mail that was sent out to everybody on Monday. Please check first your inbox. If there's nothing there, just do a direct one-on-one email and then I'll follow up with a response on that.
John, yes, we did receive the mail with the attachments, but this particular presentation that he used now, is that included in that? Or I'm not sure.
No.
That's what I'm asking.
No, our agreement yesterday was that we will wait from releasing the presentation until we've finished the session. So look out for that this afternoon, latest tomorrow morning. They are ready.
Okay, great.
I think there are also a few other additional documents that we'll be sending your way. But yeah,
perfect. Thank you.
Held to this ones until the last.
John?
Sorry, John.
Hi, Henry.
Oh.
Go ahead, Henry.
Sorry, is it me or is it Henry?
Douglas, go shoot first. I think myself and Henry will go last.
Okay, thanks, guys. Guys, a quick question, because, okay, I've got the model as well, and I've been working through it, but of course, some of the, the spreadsheet has got certain fields that's locked. Right now, especially I wanted to do a bit of sensitivity analysis, etc. But of course, like, you can't change that. Is there a way one can probably get the password to unlock it, or is that not an option at all?
Douglas, the long answer short is no. The SHRA doesn't allow us to unlock the spreadsheet. And the reason for that is going back to the fact that putting ourselves in their shoes. It's a template which is going out to a lot of applicants. So in order for them to be able to have consistency in assessment, both internally and with the external assessor, there has to be some regulation on how you can change the model. Otherwise, it'll be impossible to assess all the different applications.
Okay, fair point. Thanks, Ed.
John?
Henry? Oh, is that Putty? Sorry.
It's Putty. Yeah, it's Putty here. Will the recordings be made available to us for the both of the 2 days?
Certainly. I think Mandla, if Mandla is still with us, not Mandla Kumalo, but Mandla Muchoko, he can speak to that. I think there's a way in which they put it on, what's this, YouTube, and it can be easily accessed on that platform than you putting it on email or something like that. Mandla, if you can hear us, just provide some clarity on that, how it goes. But yeah, we have recorded the last 2 sessions, so they should be available as soon as we are done. Give us some time, because I know that the files currently are sitting with the facilitators team, because there was just a delay on my side to do the recording. So
yeah, yes, John.
To get them submitted on our end before release them, so to say. Mandla?
Yes, Bro John. Hi, guys. The recordings will be downloaded into SHRA YouTube. So as soon as we download the recordings, I don't know, maybe you should check in a day or 2. They will be there. But if you're still not getting them, you can send it. Are we uploading them? Because now it's all for different trainings that we are doing. It's not one. It's all about 6 or 5 of them so far.
Yeah. Thanks, Mandla, for that clarity. Colleagues, I'm just looking.
Oh, sorry, John. Sorry. You know what you guys have done before, which was, I think, very efficient. what you did, you sent an email to all the attendees with a link to download this, using their own data and stuff. Can you do that? You've done that before. The presentation with Rory, I think 30 September. You send a link to all the attendees to then further download wherever at their convenience. Will that work for you?
Yeah, so from that link, you still use the same link to access more trainings. It's not changing. It's the same link which gets you to the YouTube.
Okay, great stuff. Thank you.
Yes, the same link.
Please allow me to, ladies and gentlemen, I see that we're fast inching towards the 1 o'clock mark, and that was our commitment. And I know that a whole range of us have other commitments beyond this. To perhaps then do my piece in terms of the announcements, but just as a wrapping up piece on my end. Henry, I'll give you last so that if there's anything else that people want to take forward, they can just then sensitize us on. One, just as a general request, just as we did yesterday on your chat, give us feedback in terms of what your observations were or are regarding particularly QuickScan C. Has it been easy? I know it's quite a heavy topic or subject on its own, but gladly we have a very capable presenter for this one who's able to unpack some of these things. So just on your reflection, colleagues, broadly give us your sense, because I think even in crafting the closeout report on this project, it would be, to be value add to not just thumb suck or speak from our own heads, but really be informed by your inputs as participants or as delegates into this. I committed to sharing information on the grants. Other than the CCG grant, I'm not going to be speaking about that, but there are, in essence, 5 support grants that we also administer up and above the CCG. And I want to just perhaps speak about that myself, and Ms. Poswa, who I saw also through a comment, are the specialists within the SHRA that are administrating those grants. The first one, and I may bore some because some of you were part of the introduction session we had last week, and I mentioned this. So the first of the 5 is what we call the pre-accreditation grant. Henry in detail spoke about, the need for an SHI accreditation versus the ODA and so forth. So this is a pot of money that's been set aside by the SHRA to assist the accreditation efforts of the aspiring SHIs. And also it says there in the policy document that governs this grant that it is money that can also be used to upscale capacity in the newly established or newly accredited SHI. There is more detail. I don't want to go into the much detail. I will at the end release to you a policy document which speaks to all this in greater detail in terms of who is eligible, what is the grant quantum in there, and what is the application process and so forth. But that's just to give you a synopsis. That's there's a pre-accreditation grant to assist in the main social housing institutions that wants to get accredited, or those that have just been newly accredited, but they need to move a step further in terms of building the in-house capacity. Now, the second one, which is critical and linked to what we've been dealing with for the last 2 days, it's what we call the project feasibility grant, and it's about 500,000 rands, 500,000 rands, available in this pot of money. It is available to both institutions, social housing institutions that are accredited to develop and manage social housing stock, but it's also available to ODAs. And the intention really, long and short, is to assist those applications that have been lodged with the SHRA in the pipeline to say, here's an application, we have assessed or pre-assessed it, And we find that if it can only close this 1 or 2 or 3 gaps, this application can then run its full course. If you remember yesterday, Henry took us through a SHRAS process, that Vuvuzela thing, and unfortunately I can't ask him to bring it up, but there was that slide that he displayed, which shows the entry point where projects comes in up until they reach cancel stage where they get approved. So in between, as the project progresses towards that end, sometimes we need to give them a nudge. We need to close certain gaps. Those gaps could be either doing a demand study for that particular project. Those gaps could be either doing a traffic impact study or a combination of the two. Those could be doing a geotech, desktop geotech. Those could be, so the whole range of things. I know it's quite a small amount of money. So it comes from an assumption that a whole lot of other work relating to that particular application should have been done. This is just simply to close and tighten that application so that it can be considered favorably by the powers that be at council level. So that is the second one. And the application process is that the project application must have been first lodged, or there we go, must have been first lodged with Ms. Shilombe Mageza, who is the project accreditation specialist within the SHRA, and I'll give you her email address. So you submit the application, and the process that once they receive the application, they do a pre-assessment exercise. That process then spits out a report that is then used as basis to say, this project application requires that support, or what we are picking up in here are very detailed and long-term interventions that are required to get this project application to readiness. So that is the process. It must first be lodged with Ms. Shilombe in the project accreditation specialist, and then we then are able to pick it up from there. Moving on from the project feasibility grant, we also have the staff Gear Up grant. And the essence, colleagues, of this grant, in fact, just from quantum base, it's 500,000. And it's premised on the basis that because you are first taking on a project which has not yet generated any revenues, there's an understanding and appreciation that says to assist you in those first, let's say 6, even 9 months, depending on how you project it, you will still be tenanting and taking on these units. You still need, though, to have a staff structure set up and in place to assist you with those unit take on. Your operational staff, that could include your leasing staff, your facilities management staff, your marketing guys, and so forth. So this is the grant that then says we will help you to pay the salary costs of those operational staff. But I want to just also emphasize that it doesn't pay your senior and executive management salaries or your board fees and things like that. It's really to assist you with the project take on. And as I said, it's about 500,000, which we require that it needs to be laid out over a period of either 6 months or 9 months or whatever period that it is that you want to project it over for the take on of that specific number of units. If obviously when it phases out in your forecast, it must show that at a certain point, you are starting to, the units are being tenanted, there are warm bodies moving into those units, and you are starting to receive the revenue, so that when the grant dies off, there is that money that is available to take on. In fact, of all the 3 grants that I've spoken so far of, this one actually is money that would then be deposited or dispersed straight into the SHI as a bank account. So the others, it follows the government, the SHRAS procurement process, where would then sit and appoint the professional team who then works on the project feasibility application. Similarly to the pre-accreditation, a consultant would be appointed and they get deployed to come and work with you as an aspiring SHI. The fourth is what you call...
Can we just ask for number 3? Does that only apply for SHIs?
Yes. Yes, so it's there to aid in the main SHIs. If I may, so the fourth is the general capacitation grant. The policy in which is written around this, it actually it's not prescriptive of the amount. It's quite open-ended. And this is pot of money that we really use to do your research work in the sector, training such as this ones and many other capacity building efforts that we do. But we've seen that even in assisting to build capacity in SHIs, this pot of money has also been used to deploy, for example, a resource such as a development manager for a period to facilitate, for example, the development of a specific project. And there is that, and that is the fourth of the support grants that is available that we administer. As I say, I will share with you the policy document which goes into detail about each of this. The final one is really the remedial action grant. And again, it's only for social housing institutions that are accredited and are required by law to be reporting on their business and their doings to the SHRA. Reporting SHIs, I think they are reporting around 4 or 5 benchmarks and KPIs, such as how are they doing with management of vacancies, how are they doing with collection of rent, how are they doing with maintaining, keeping within the benchmark of operating costs. So where we pick up during their term of reporting that they are not performing in those KPIs, we are able to come in and intervene and get things sorted. And there again, it's not really prescriptive in terms of how much an SHI can apply for support in that regard. So those colleagues in a very quick manner are the 5 grants that are available really to assist with some of the work that you may want to engage yourself in. I said I will share with you also Ms. Mageza's contact, so that relating to what we've been doing for the last 2 days, you may want to go back to the drawing board and say, here is a project that we want to really test with the SHRA on. So here's your first port of call that I think you would be best to communicate. You don't go to the CEO's office, you don't come to John, you don't go to anyone, but here is your champion. Ms. Mageza's email is shilombe@shra.org.za. Shilombe, I'll spell it for you. It's XILOMBE, M for mother, @shra.org.za. She's the one who would receive your, or thanks to do, I see today has put up that email on the chat line. She's the one who would receive your application.
Please repeat the email again. Sorry.
I beg your pardon, Karaba?
Please repeat the email again.
Oh, it has been put on the thing, but Shilombe.
Oh, okay.
Yeah.
Thank you.
So any application starts there, and they do that process of assessment, and if there's need for support, they are able to then give us a nudge to say we need to be supporting or considering a support. I don't make a decision. The process, in fact, just back to the project feasibilities, that once we have that report and you as an applicant are absolutely in need and agree to that, we then prepare a report that goes to EXCO, and that's the body that decides on the grant, whether you get or you do not get the grant. Last piece that I really wanted to touch on before I hand to is just to say.
John, can I just add something on what you were just saying regarding the grants, which is something very important that people need to understand, is that you don't go and get your architect to do work and then you come to SHRA and say, SHRA, can you please, I'm applying for a grant to pay for my architect or to pay for an engineer that I have used. It doesn't work like that. You need to, if you see that you've got a shortfall and you need some financial assistance, you send an application to the SHRA for a grant that you are requesting. And then SHRA will, after being approved by EXCO, will then appoint a service provider to do the work for you. SHRA does not pay any grant funds except the staff gear up to the entity. So it is important, because I know that we have had people listening to this kind of information, and then all of a sudden they come, they say, can you please pay for my architect? Already the work has been done. So it doesn't work like that. We are also guided by procurement processes and legalities thereof. So it is important that if you have any inquiry regarding assistance with the funds, please engage with us first so that we can assist you and take you through the processes. Thank you.
Okay, thanks, Duda. I hope that colleagues, you got that. So it does not apply in retrospectively. We work on what is currently is the gap going forward. What we have done in the past and the cost thereof, the grant does not go on that basis. Karabo, I see you have your hand up.
Yes, I'd just like to ask a question quickly. Does the grant feasibility study available for an evaluator?
Yes, so long as it's not a long term, for example, I'm not a technical, but I've always had colleagues say, if it's something to do with, for example, a township establishment or proclamation application, which for one seems to be a very lengthy process that might not even see the day of light, we would not intervene, or usually the motivation is to say, no, you can't intervene at that stage. But if things are things that can be nudged and addressed in a quicker manner over a period of 5-6 months, the grant would be considered favorably.
Oh, okay. Yeah.
Yeah.
No, thank
you. Like I said, I will be sending email with the checklist, with the presentation that we have had for the last 2 days, and Manda will assist us with the recordings of the last 2 days. I think that's it from my end, colleagues.
And the provincial, the list for the provincial.
Oh, yes, thanks, Alfonso. I had forgotten about the PSCs, yes. Okay, so those are the additional handouts that I'll be sending you. But as I said, if you have not received the other pack that we sent on Monday, please give me a hint on email so that I can respond only to yourself. Henry?
Yeah. Thanks, John. I just wanted to thank Komotso for today's presentation, and the rest of the team, Francis, for all the time and the hard work that they put in ensuring that the presentation flows smoothly. But more importantly, I would like to thank you, the participants. I mean, this was one of the, John, I would say, very interactive sessions that we've had for some time. And what we try to do with all the questions that we've been asking is we always try to improve in terms of our next presentation. So we always try to take all the questions that you've been asking and try to refine our presentation so that we can bring all these questions into account, and that the presentation becomes very informative. But more importantly, we want to thank you for the 2 days, very informative, very thought-provoking, and I hope that you have also gained 1 or 2 things from these 2 days.
Thanks, Henry. Colleagues, I think on this point, we will close the call, but again, reiterating Henry's sentiments. Thank you all for staying the course and being with us. There are obviously other training programs that or topics that we will be facilitating, and there's a program that speaks to that. So if you need to know more, let us know so that we can share with you what those topics are and which days we're running those. On that note, thank you. You can log off. Can I just request that Henry, Khomotso, Dudu, and a few of the organizing team just stay on the call for just a bit of reflection while everybody is logging out. Thank you all. Cheers. So Henry, I just also did the same. Even after being told several times that you must press the record button, I again forgot. But thank you for taking care of that.
John,
you know who has been recording?
John,
Mandla, just to our respect and Kulma Nomtom you don't
Yeah.
even have hair, let alone gray hair.
Before you finish with Henry, I'm saying to you, one of the attendees, I think it's Sean, was complaining that when we download the video, they don't want our debriefing on the video. They don't want our debriefing on the recordings.
Oh, so you need to stop recording now
And save.
yes.
But how do you communicate with Henry now?
No,
So stop recording and save.
Yes.
Khomotso?
John? Oh.
Khomotso? Is he there?
Khomotso.
Yes.
Yeah, he's still here.
John,
Yeah, he's
Khomotso is
back.
actually recording from his side.
Yes.
Khomotso?
Is it Khomotso's recording it?
Yes.
Oh.
Yes.
Mr. Khomotso, we need to stop recording.
Okay. So I must stop now.
But after stopping, you need to save.
Yes.
Yes.
Okay, I'm stopping the recording.